is Frank Aibogun. I am a publisher of Business Day. What a delight on a very bright morning in Lagos to welcome you to our 2020 series of our Capital Market and Investment Conference. Today, the conference is by way of a digital dialogue, a virtual convening as a result of the very unusual times that we are in. But thankfully, we see evidence, very clear evidence suggesting that the ravaging of the pandemic is easing around the country and even more so in Lagos. I was looking at a graph done by one of my colleagues in the office this morning, and it's such an impressive thing to look at. And we even also try to check up on cost of things like gloves, hand gloves, face masks, and all manner of things. Even the thermometer that went up as high as 80,000 naira in Lagos, the prices have all crashed, all an indication of the improvement in the environment. Today, our conference is one that focuses on a number of issues. We would have a conversation with the Director General of the Securities and Exchange Commission, who I am happy to say has since joined us. We would have the CEO of the Nigerian Stock Exchange, Oscar, give us an opening remark. And then, of course, a number of presentations that will be made later, one by Eric, who's joining us from London, and then, of course, Haruna Jallo Waziri, the CEO of the Securities, Central Securities Clearing System. We have two panel sessions, very interesting, given the themes that they will be exploring. Our first panel will be titled Row Your Boat, an Investor's Guide Through Choppy Markets. And of course, our moderator will be Bolanle. And then we would have a presentation by Guy, the head of research at Coronation Asset Management. And his presentation will be focused on rediscovering risks. And Guy will be helping to calm us down, because he believes it's not as, we will see whether that's it. He believes it's not as bad after all. Then, of course, there will be Ni's presentation. And then we would have the second panel, which will be moderated by Tosin. And thereafter, we will seek to bring today's conversation to a close. We will not have been able to do this morning without the support that we have received from our very, very strong partners in the Nigerian Stock Exchange, EFG Hemis, Commercial Partners, VFD Group, Sky Trustees, Alliance LP, FBN Quest, and of course, Ancoria Asset Management. My task this morning is a simple one. It is to welcome you all warmly to our 2020 Investment and Capital Markets Conference. I think I've done a good job at that. Permit me now to acknowledge the presence of the Securities and Exchange Director General, and to say that in the course of today, I will have the privilege of a short fireside chat with Lamido, just to explore what his key goals are for the capital market. So, ladies and gentlemen, you're welcome. Thank you so much for joining us. It's a bright morning in Lagos, and I have absolutely no doubt that the time you spend with us today will be for you a good and fulfilling time. Thank you so much for joining us. And I think at this point, I'll yield the floor so we can take a message from the CEO of the Nigerian Stock Exchange, Mr. Oscar Oyema. Thank you. I think you are muted. You are muted, Rolly. You are muted. We're not hearing you.
Yes, sir. For the opening remarks, it is now time for us to listen to the presentation from the CEO of the Nigerian Stock Exchange, Mr. Oscar Onyema.
Distinguished ladies and gentlemen, if there is any good thing that we can take away from these unprecedented times, it is the ability to adapt to globally evolving digital trends, which is why my recording now seems permissible in today's world of virtual engagements. I am pleased to be here today at the 8th Investment and Capital Market Series organized by Business Day. I must thank the leadership of Business Day for putting together such a high-impact conference, the Borders on Nigeria's Capital Market and Economy, which I'm honored to address. This initiative is laudable as it is necessary to engage in conversations on the nation's economy, especially as we are in unprecedented times, evidenced by high volatility, uncertainties, and fears of looming recessions across the globe. I should start by reminding us that two essential parts of a nation's economy speak to the direction and capacity of trade and investment. These two elements are intertwined such that it is unlikely one survives without the other. Suffice to say, without investment, trade is limited, and without trade, investment is likely useless. This again is why I believe this initiative is timely and one that the nation needs at this time. 2020 is a unique year in so many ways, and it is not surprising that this Nigerian Stock Exchange, the COVID-19 pandemic has resulted in a decline in oil export earnings, which accounts for over 80% of Nigeria's export earnings, and remittances by Nigerians in the diaspora. Concurrently, foreign portfolio investor flights to safety has further intensified pressures on the nation's. However, despite the highly volatile macroeconomic environment in Nigeria, the Nigerian Stock Exchange has remained resilient. Surprisingly, domestic investors have risen to the occasion in sustaining equities market performance. The low-yield environment has positioned the equities markets as a credible investment option for domestic, institutional, and retail investors. This year, domestic investors have accounted for almost 60% of the trading activity, compared to an average of 51% in the past 4 years. Despite obvious economic headwinds, the NSE All-Share Index, for instance, rose by 16.39% in the month of April, ranking it the second best performing index in that month, according to Bloomberg. The NSE All-Share Index at the end of August returned month-on-month gain of 2.47%, and the equity market cap currently is at about 13.2 trillion naira. While we have witnessed a slowdown in equity capital raising due to the impact of the pandemic and decline in oil prices, we have seen increased capital raising activity in the fixed income space as a result of the relatively low interest rate environment. In Q2 2020 alone, we saw new corporate debt issuance valued at 203.5 billion naira, as well as 567.39 billion naira in government debt listed on the Nigerian Stock Exchange. As at today, our bonds market capitalization is 16.2 trillion naira. We have also seen a growing appetite for alternative asset classes from investors. Similar to the growing demand for gold and gold ETFs, the new gold ETF listed on our bourse since December of 2011 has enjoyed considerable traction since February of 2020, pushing the ETF cap to 14.5 billion naira. When COVID-19 hit Nigeria, our business continuity framework was activated with daily monitoring and assessment of the situation. We ensured that temperature checks were done daily and provided hand sanitizers and health guidelines on all floors of the exchange. Subsequently, on March 25th, the physical trading floors of the Nigerian Stock Exchange across the country were closed and have been that way with our staff fully migrated to remote working and the broker-dealer community fully migrated to remote trading. Yet more than ever before, the exchange has been open for business, giving issuers and investors a platform to access right-sized capital in the toughest of times, whilst providing opportunities for secondary market trading activities across our multiple asset classes of equities, bonds, and exchange-traded funds. The NSE's technology platforms have supported our dealing members in trading remotely every working day without incident via our electronic platforms, such as our fixed protocol, our XNet platform, and our newly implemented virtual private network. In some quarters, I have called this business unusual, as this is the first time in our history that our staff are stationed for work remotely as we continue to double up on efforts at ensuring that the exchange remains a beacon of hope and business continuity for the Nigerian economy, even under such trying times. Our short-term plan was to protect our internal and external stakeholders from the exposure of COVID-19, ensuring our stakeholders' experience engaging remote working and remote trading remains seamless. I personally updated employees on a weekly basis of all the actions being taken to ensure first their health and safety, as well as palliative measures being considered for their sustenance. We also scaled up and leveraged our online learning management system, the X Academy, to remotely deploy capacity development programs, both to our employees and to our ecosystem. With the lockdown and restrictions in movements, we alerted issuers to avail themselves of the relationship management tools and regulatory filings via our issuers portal, popularly known as X-Issuer. We also initiated a CEO virtual courtesy call to our listed companies in order to bring the exchange closer to them in every way possible and understand their concerns with a view to resolving them. We engaged with the federal government and regulators on issues of annual general meetings, maturing financial instruments, financial reporting, to mention a few, in order to secure the right regulatory actions and responses for the benefit of our ecosystem. In the middle to long term, as we continue to ensure that we provide all that is needed for our stakeholders to work and trade seamlessly from their various locations across the country, we continue to monitor the pandemic through our Business Continuity and Crisis Management Committee. We are also focused on delivering the demutualization of the Nigerian Stock Exchange, which is currently at its final stages. The demutualization of the Nigerian Stock Exchange will see the exchange transition from a company limited by guarantee to a company owned by shareholders. Some of the benefits of demutualization are the creation of more opportunities for investor participation, improved corporate governance, access to broad pools of capital, and technological innovation, amongst others. With demutualization, the exchange joins the league of exchanges in the world with global competitiveness, which will adversely lead to increased global brand and visibility of the NSE for the benefit of the nation, particularly as it concerns the development of the capital market and the economy. The Nigerian capital market itself has been undergoing a number of developments guided by the Capital Market Master Plan, which is halfway into its implementation. The plan promises to enhance investors' confidence, improve liquidity, and create an enabling environment for the creation of new products. I'm delighted that the DG of the Securities and Exchange Commission, Mr. Lamido Yuguda, is here and believe he might speak further on this ambitious plan to transform Nigeria's capital markets. Popular concerns of our stakeholders this period have been access to Forex, with other concerns bordering on current economic projections and stability of the Naira. Because of this unique situation occasioned by COVID-19, and to ensure the stability of the Nigerian capital market and recovery of losses, I use this opportunity to again send word on policy inclusiveness to the government for consideration. One of such recommendations is to expedite the unification of the exchange rate by converging all foreign exchange windows to the investors and exporters rate in order to boost foreign and domestic investor confidence in government's commitment to economic sustainability. We believe the government should also ensure regulatory forbearance with focus on pandemic alleviation schemes, such as reduction of tax burdens for already compliant organizations, mainly listed companies, delayed implementation of any new taxes at federal and state levels, targeted intervention for local companies across sectors most hit by the pandemic, and fast track of other investment attractive legislations, such as the Pension Reform Act and the Investment and Securities Act, which are currently being reviewed. I should add here that the recent CAMA that was assented to by Mr. President sends the right signal of hope for the improvement of the ease of doing business in Nigeria, which will accelerate the development of the nation's economy, and the NSE is proud to have contributed to this effort. Finally, on recommendations to the government for the benefits of the capital markets, one of them would be the expansion of the framework of public-private partnership for infrastructure development. For instance, prioritizing the incorporation of the CBN infrastructure company, Infraco, and subsequently listing its 15 trillion naira fund on the Nigerian Stock Exchange for effective reporting, governance, and other global fund management standards. And 2, converting the road investment tax credit scheme into NSE tradable tax credit notes to further incentivize private sector participation in Executive Order Number 7 on road infrastructure development. As I round off, I leave us with the old investment adage, which is to focus on time in the market, not timing the market. Many times, investors are bothered about the right timing to take an investment action. However, one of the reminders COVID-19 has given to the world is no one can adequately predict what would happen. Whilst it is necessary to prepare for shocks wherever, it is also beneficial to stay invested for many years. As we navigate the rest of 2020, it is necessary to play the long term, keeping abreast of information. The NSE's data services are available to help you stay abreast of market development, and the X Academy, our learning management program, is available for capacity development on several levels of professional and personal development. Again, we should remember that it is time in the market and not timing of the market that counts. Once more, I thank the board and management of Business Day for inviting me to participate in the discussions today. I wish the speakers, expert panelists, and distinguished ladies and gentlemen fruitful deliberations at this summit. Please stay safe and remain connected to loved ones. Thank you for listening.
Thank you, Mr. Onyema, for the insightful presentation on developments within the Nigerian Stock Exchange. As we proceed into our discussions, it is important we also hear from regular investors to know what issues they consider pressing. At this point, I would like to invite Mr. Kalu Aja. Mr. Aja is not only a distinguished career in asset management, he's also a foremost commentator on financial planning, capital markets, and the Nigerian economy. We expect Mr. Aja to raise questions he wants addressed in the course of this conference. Over to Mr. Kalu Aja.
Hello, my name is Kalu Aja, and it's my pleasure to talk to you today on the occasion of the Business Day 8th edition of the Investment and Capital Market Series. First of all, thank you, Business Day. Thank you for doing this. We appreciate you. I want to talk about the Nigerian capital market and as my experience as an investor. 2019 was a bad year. We left 2019 with about a negative 14 return. And what struck me really in 2019 was the mobility of capital, that a Nigerian could in Aba have an app on his phone, say Trove or Bamboo or Robinhood, and he could move funds from Nigeria and invest in the US market. That was options. So the Nigerian investor is not really stuck anymore in Nigeria. If options are available, he would invest cross-country or cross-borders. Second thing was that fixed income returns in Nigeria were very, very good. So the investors had tons of options, not just across countries, but across asset classes. That affected the Nigerian capital market, and that really pulled us down. But it wasn't all bad news. I mean, the NSE has done a lot to try to broaden the scope of the market, and which takes me to my next point. The NSE did launch the growth window and to bring in the SMEs into the market. Before I came here, I asked my Twitter followers, have you guys heard about the growth window? Not a lot had. And Not a lot. Not everyone that's heard about it during the lunch, but don't know what it is. I would say outside the professional stockbroking or stock market class of people, the market is still viewed with a bit of elitism. People think we just come here and we trade. They do not connect what the stock market does with what SMEs do in price discovery, raising long-term funds, and all that. It could be a combination of lack of information. It could be a combination of the high cost to get registered, the 50 million to get registered into the growth window. It could be both. But the point is that the NSE has this wonderful concept called the growth window, and the market doesn't know about it. And the market can only know about it if we tell them about it, number one, and if they see the benefit to then come to the benefit of basically being in that market. So I think my point for the whole conference is simple. Can we talk about how we can bring in more SMEs, more millennials into the market to get them to invest and success? I mean, SMEs are huge, 41 million SMEs all across Nigeria, employing about 84% of the population of Nigeria are employed by SMEs. This is a market that we must play in and we must drive and we must be a partner with. So I will say specifically to the growth window, can we review it? Can we bring down the minimum capital requirements up to say 25 million? Can we talk more? Can we get CBN to say, apart from doing just loans, can they do equity contributions? And can we tie those equity contributions to the growth window? Questions for the conference, and I wish you all a very, very good time. Thank you.
Thank you, Mr. Aja. We are sure your comments will be addressed in the course of this event. At this point, we would like to welcome Mr. Eric Renanda to come and deliver a presentation on Chasing Alpha on a Treadmill, a fund manager's view of trends and bends in the Nigerian market. Eric is portfolio manager at H1 EMIM Africa Fund in UK. Over to you, Mr. Renanda.
All right, thank you very much. It's really good to be part of the conference today, and I'm sorry I couldn't be actually in Nigeria. It's always fun to visit. I think I'm here to provide the perspective of a foreign investor in Nigeria, and I'll try and be as frank and honest as possible. And Business Days came up with some questions they put together that they thought would address the issues that you guys are all thinking about. So I thought I'd just answer some of these questions that they posed to me. The first one was, how do I think that the markets will recover from the coronavirus, and how are portfolio flows and money going to shift post-COVID-19, especially as it pertains to frontier markets? I think one thing, I just want to share some numbers with you about how money has shifted already this year. You've had $1.1 trillion going to money market funds. You've had $200 billion going to bonds, $70 billion into gold, and about $40 billion out of equities. So you can already see, well, I'll just say within equities as well, the 40 billion, you've had about $10 billion into international markets and $40 billion out of EM. So you see the broad outline: big move to cash, big move to fixed income, gold, and then a bit of a move out of equities. But within the equities, it's a little bit into international markets, developed markets, and then a little bit out of EM. So definitely a move to safer assets in those flows. Second, I think that as it pertains to frontier markets, it's important to recognize the crowding out that's coming from China. China is almost becoming its own asset class or its own allocation. You know, it used to be US, Europe, EM. That is now kind of evolving into the US, Europe / international, and then China in itself as an allocation. And then you have rest of EM, which would be like Brazil, India, Turkey. And then you have frontier after that. So kind of frontiers becoming at the end of a long list of major regions that people are allocating money to. So I think it's a little bit tough. It's going to put pressure on frontier market allocations. Also, as the firm I work with is associated with a private bank in Belgium. So I get to listen to some of their investment committee meetings and what their private bankers are talking about. And the interest is definitely just in, this is well to say not just, but primarily interested in US tech, Chinese tech, and then when it comes to emerging markets. Not much interest on the equities, but more into maybe the yield stuff. So definitely there's that pressure in Europe and around the world that there's 0% yields or negative. And so they do look to emerging markets for the yield. So I think that's the outlook for the frontier markets. The other question they asked was how my framework, my investment framework has changed post COVID-19. The framework is still the same, how I look at investments. The one new change is on the regulatory side. I run a European fund with European regulations. It's called a UCITS reg fund. And the European regulators are being a lot stricter on liquidity. They don't like the idea of funds that are saying they have daily liquidity, but the underlying assets are not that liquid. So starting in September, we have to start doing stress tests, liquidity stress tests as a fund manager, which that never happened before. So I think that maybe puts a little bit of, would make fund managers a little bit more cautious about frontier markets or less liquid markets, because there's going to be an extra scrutiny now on the liquidity of the investments. So the third question was, has investing in Nigerian treasuries lost its appeal? And what are the realistic options for government and corporate borrowing in Nigeria? And I would say the appeal around Nigerian treasuries has definitely changed. I used to be very interested in that market. I jumped in 2017 when the Naira devalued and the rates were 20%, and it might have been higher. And so I owned the Nigerian treasuries up until February this year, when I made a trip to Nigeria, and I got anxious that there was going to be currency problems. And so I sold all my equity and T-bill positions in Nigeria in February. And yeah, I think the FX policy of the CBN has really, it's really hurting the attractiveness of the Nigerian market in general, both on equities and fixed income. And also, even if you wanted to take, as a foreign investor, even if you wanted to bring your money into Nigeria with the risk and unknown of when you're ever going to get it out again, the 2% yield isn't enough to compensate for the likely Naira devaluation. So I think, yes, that has killed the attractiveness of the T-bills to foreign investors. As far as Nigeria's funding ability going forward, it's probably going to be like what we've seen in the rest of Africa, or for many countries in Africa. It's a mix of tapping your local market as much as you can to the banks, hitting the euro-dollar market, which is still open, and people would buy Nigerian euro bonds. And then is also trying to borrow as much as you can from the IMF and the World Bank. I think people are worried about corporate financing in Nigeria. I would imagine that with 2% treasury yields, the banks should be quite open to lending to corporates. So I think they're going to be pressured. I mean, obviously there's a risk-off environment, the economy stuff, but they're going to be under pressure to earn yield. And so I think they will want to lend to corporates going forward. The next question was, what is your view on the recovery paths of the two giants of the continent, Nigeria and South Africa, especially since both slunk into the disruptions of 2020 and already weakened economic positions? What are your thoughts on their recovery paths going forward? I'm a bit optimistic on South Africa. They've had, they elected Cyril Ramaphosa 2 years ago in 2017, the end of 17, and people have been frustrated that there haven't been the high-profile arrests that they really are hoping for, but there's been a lot of groundwork to change out leadership positions throughout the government. For example, the head of the National Prosecuting Authority was fired. The head of the Tax Revenue Service was fired. They changed out the entire board of directors of the Public Investment Corporation, changed out the management of the power company, Eskom, changed out the management of Transnet. And they're put the big airline, South African Airways, into administration, and that's either going to be shut down, but probably more likely spun out as a smaller airline. So I see a lot of changes. It's hard work. The corruption was obviously endemic throughout the government. And it's, they say it's easy to break things down. It takes a lot of work to build things back up. So, but I think, I think South Africa is making progress, and the wheels are turning in the right direction. So I'm kind of optimistic there. Nigeria is less, it's harder. It's a mix, more of a mix. The positives on the removing the fuel subsidies and changing the power prices to make them more reflective of the actual cost of power. Those are positives. But then the negatives are around the FX policy right now, closing borders. And so it's tougher to see with Nigeria. I think it's going to be, it's maybe in a holding pattern right now in terms of the outlook going forward. So a bit more optimistic on South Africa, I'd say. And then going from that, what mega trends do I see shaping the sub-Saharan Africa going forward? I've got quite a negative view just generally on the overall outlook. We were in a very negative, very big recession globally, and we were kind of weak coming into this. And I think we're going to be very slow to come out of this just globally. So I think there's a lot of headwinds for Africa just coming from the rest of the world. But the positive thing is that Africa might outperform the rest of the world going forward. I mean, theoretically, on paper, Africa is coming from a very low base, very responsive to changes in efficiency. There's a lot of opportunity to make things more efficient in Africa. So on paper, Africa could grow even if the rest of the world isn't doing so very well. So that's a reason to be optimistic. But otherwise, I'm also kind of positive on the leadership changes I'm seeing across the continent. Basically, the real bad guys you're seeing kind of eventually get changed out, and you get better leaders. A lot of pressure from the youth with social media to improve governance, reduce corruption, which you are seeing still there, but you do seeing a lot of pressure on corruption. So I think generally you're seeing better governance across Africa. And then finally, I'm optimistic about the Africa Free Trade Agreement. I mean, amazing that I think it was 52 countries signed this agreement, and people are skeptical of what it will amount to, but it does start to lay the framework for increased trade within Africa, which could be a real big, one of those, very powerful trends that exerts itself over the next 10 years. And maybe you don't feel it in Lagos, but there has been quite a bit of an investment in infrastructure around the continent, in new train lines, ports, roads. Still lots of work to be done, but there has been some improvement on this. And so I think trade could be something that does be a mega trend for sub-Saharan Africa going forward. And finally, the mobile economy, I'm very bullish on. There's been a lot of innovations in mobile economy, mobile payments, and I think that's really creating a great opportunity for people to educate themselves, get new information in ways they couldn't before, and also interact and do business with their phones, which we've never seen before in the development of emerging economies. So I think that's also that trend is a big one too. The next question was, what is my view of the Africa Rising theme? And do I worry that maybe we're going to lose the gains of the last 2 decades? I would say, I just want to say, I think the Africa Rising theme is kind of feeling a bit dead right now. And we recently had a redemption from one of our investors, I think it was a Danish fund. And they sent an email with their redemption request. And I just wanted to share the comment. I thought it was indicative of maybe, I have my views. I think the theme is quite not holding up very well right now. But then this investor wrote, "We have decided to terminate our investment in the Duet Africa Index Fund. We have been in the fund for almost a decade, believing that a positive economic development would eventually reward us for our patience. That has so far not happened, and we fail to see that the situation will change anytime soon." So this is someone that's been invested in Africa for 10 years, and they finally just given up and want their money back. So I think that was pretty indicative of where the Africa Rising theme is for investors right now. But I think it can happen. I think we're not going to give back the gains of the last 10 years. The pace of reform, pace of Africa Rising theme has been a bit disappointing, especially relative to other regions in the world, especially Asia, the changes they've achieved over the last 10 years. So we have a lot of work to do, but I think let's just do it. Let's just act, focus on acting, focus on fixing things, reforming things. And then in 10 years from now, if it has happened, then we can write newspaper articles about it. But I think for now, we should probably just not talk about Africa Rising and just focus on action. Next was, what is the current view of the HIEMIM Africa Fund to securities investing opportunities, both debt and equity in Nigeria? And how are you shifting positions across the alternative opportunities across the continent? So as I said, I was in Nigeria in February and ended up selling all my positions, nervous about the oil price, nervous about the currency. And so we currently have any investments in Nigeria. Our fund is highly regulated with weekly liquidity, so I don't know what to do. I mean, it's hard for me to come into Nigeria when I just have no idea when I'm going to get my money out again. I think the regulator would probably put me out of business if I did that. My biggest concentration is in gold miners in West Africa and South Africa. I believe there's a bull market right now in just fear, anxiety, debt issuance, and bad government policy. And I think those are all kind of bullish for the gold price. We do have some investments in the mobile economy. As I said, I'm really bullish on that. We do own MTN, which you guys will know well. So I am bullish on mobile economy and mobile payments. And I've been reluctant to invest in African government debt. I think we saw with I've been concerned about, I think African government finances in general are very fragile. And I've been concerned by how much a lot of these governments have tapped the dollar market. And I think it makes the country very fragile, very sensitive to the dollar strength. And so I think we see that the finances are in tough state, and with the coronavirus, there was an attempt by quite a few governments to maybe not pay their interest and payments on the euro-dollar bonds, which I think was indicative that this is, where it made me cautious on the market. And so, and generally, I'm very cautious with the fund because I think we're possibly in the early stages of a longer recession. So that's how we're positioned in the fund. We do have about 15% of the fund in U.S. Treasuries, just rather than owning the government bonds. It's not much yield, but I feel like it's safe. So what has been the fund's source of outperformance? Since I started the fund in March 2015, the S&P Africa Frontier Index is down about 32% in US dollars. So Africa is down about 32. The fund is up about 15% in dollars. So that's 47% outperformance over the 5 years. I'll tell you, investors in Europe and the US don't really care about making 15% over 5 years. They think that's kind of unimpressive. They'd rather own the S&P or the NASDAQ, especially. But relative to Africa, it is pretty good. And the key things have been really missing the big sell-offs. I was very skeptical of the African consumer sector in 2015, all the beer stocks and food stocks trading at 30, 40 times earnings with not that much earnings growth. So I avoided some of those things. I avoided the big currency devaluations and then caught a few upturns, mostly in the mining sector. And this year in gold mining. So that's kind of been how it all came together. And so so those are the main questions that the Business Day guys put together, but I wanted to share a few comments, just some final other thoughts. And maybe I sound a bit, dour on the markets, but I wanted to say this is a good time for Nigerians to invest in yourselves and in your local market. I've done a lot of work with Zimbabwe and know a lot of Zimbabweans and people I'm working with that are making a lot of money in Zimbabwe. And when foreigners leave the market and don't come in, it can create great opportunities locally for you. And so I think maybe really look around at your local companies. There could be some great valuations and great opportunities there. Especially if you're already in Nigeria. And also it sends a good sign to foreign investors when when local investors are investing. So you always want to see that the guys on the ground are bullish too. The second thing is that I ask people, I say, hey, what do you think is the best performing stock market in the world? And, I don't know, they might say the NASDAQ or something, but Zimbabwe is up 860% in the last 2 years. Yes, it's come with a lot of currency devaluation, but just pay attention that this could be a setup for Nigeria too. I mean, maybe the Naira is going to go to 550, but maybe the Nigerian stock market's going to go to 50,000. You guys could easily have a double in your local stock market. So you have a lot of banks on 2 times earnings, markets highly depressed, but generally when currencies devalue, the local stock market goes up a lot. So I would say you could be sitting in front of a great opportunity yourselves with your own local market. And then finally, I would just point everyone to pay attention to the innovations in the blockchain and crypto technology market. I've been looking at it myself and super amazed at what's happening there, and I don't think many people are focused on it. And I also think it's particularly relevant to Africa. I think in countries where it's maybe harder to access the financial system or there's restrictions on liquidity in the FX market, it's very attractive to be able to use decentralized finance applications like Bitcoin, Ethereum, and everything that's happening around that. And same way that Africa is a lead in mobile payments, I think it could be a leader in the adoption of blockchain technology as well. So I would just suggest to people, if you are not paying attention to the innovations there, just start acquainting yourselves. And that is it. Thank you very much.
Thank you, Mr. Renanda, for sharing your very interesting perspectives on the African market and particularly the Nigerian market. It was a learning session. Thank you. At this time, we would now introduce the anticipated fireside publisher, Business Day Media, Mr. Frank Aikogo. Thank you.
Thank you so much, Rolly. I hope the DJ is still with us. I saw you earlier, so I imagine you're still with us. And let me just thank you so much.
Thank you very much.
We will be spending the next 25 to 30 minutes just having a chat, very simple chat in which I will ask a few questions and give you a time so you can answer those questions that we think will help shine the light on the work that you're doing as the regulator of the market. So once again, let me welcome you, sir.
Thank you very much. Good morning, Frank.
Thank you, sir. Thank you so much. Maybe we can start. Let me ask you, you have only recently taken up this position as Director General of the Nigerian Securities and Exchange Commission. Can you just help us outline your agenda for the capital market, sir?
Thank you, Frank, and good morning. Yes, we have just assumed, I assumed duties on the 6th of July this year.
Yes.
Together with a brand new management team for the commission. We have, outlined as our key priorities, essentially a 5-point agenda. One is boosting the commission's operational efficiency. The commission needs to be, really sound in order to provide the kind of regulatory support that the market needs.
Yes.
Second is the continued implementation of the Capital Market Master Plan. We have a Capital Market Master Plan 2015 to 2025. This is halfway into that period. We have achieved, a number of initiatives outlined in that plan, but we still have a number of initiatives that need to be, pursued, and we are going to pursue those, vigorously. This plan is currently in the process of a kind of mid-term review, and we intend to look at some of the assumptions in light of the current economic realities, but we intend to pursue this plan to the fullest, possible extent. We intend also to restore investor confidence. This is a market that has really seen a lot of investors leaving the market for the past 10 years since the financial crisis. We have an average age of the CSCS customer at above 50 years, which means a lot of young investors are not really in this market. So people who have come of age and who have started some kind of economic life are not investing in this market. We have less than 400,000 CIS accounts, that is collective investment schemes accounts, for a population that is over 200 million. So that means that there is really a significant amount of work that needs to be done to increase the take-up of investment products among our population. We also want to improve the investor experience. You'll agree with me that capital market transactions are not exactly easy, at the moment. It is easier for you to open a banking account. Now, you know what happens on a banking account, but it is quite difficult for many of us to read through an investment account and the various transactions. Plus, the stages that an investor needs to go through to get, for example, just to buy some equities. It involves a lot of things. We want to simplify this process so that the experience of investors is really kind of very seamless. Then we want to improve the capital markets visibility and attractiveness. Visibility to policymakers, visibility to investors, visibility to issuers, and also the attractiveness so that there is a value proposition for those who decide to participate in this market. So this is really our agenda for the market. And we expect out of this process to have an increased perception of the Commission and of the market as a whole, a strong regulator that provides leadership to the market, CMOs, that's capital market operators, that really comply with our laws, our rules, and our regulations, with the incidence of market violations reduced to the barest minimum, so that investors will be confident that this market is actually for them and not for the operators, and a market that is really the first or the preferred investment destination for investors, both domestic and foreign. We also want a capital market that contributes significantly to economic growth. And I think this COVID pandemic has really shown us that we need to do a lot more in this area. We need to provide infrastructure for our people, especially at a time when you see a lot of countries just closing their doors to other nationals. You need to make sure that you are self-sufficient in the area of infrastructure, whether it is roads, education, health, transportation, and the like. So these are things that the capital market can actually provide. And we have the funds to actually do that. But we just need to make sure that the capital market provides the kind of vehicles and frameworks, that will attract those people and those institutions that have the money to invest, in those vehicles. So we want, in a nutshell, to be a regulator that is really a reference point in the whole of Africa. We do engage with other regulators in the continent, and we want the SEC to really be at the top of that league. This is our plan.
Thank you very much, DG. Thank you so much. So let's go on. As we all know, the COVID-19 pandemic came with a sharp fall in the price of oil, which is Nigeria's main revenue source. There is an abundance of data that suggests a correlation between oil price and equity prices or equity valuation in Nigeria. We're seeing regulators around the world aim to support markets with policy interventions and regulatory interventions. In your view, what more should we be doing in Nigeria in that regard?
I think in Nigeria, we have really a market that, has two, major things. One, we have a market that has a preponderance of foreign investors, such that when they leave for any reason, you find that the market actually suffers a lot. You have also a significant number of institutional investors, domestic institutional investors, for example, the pension funds, who are awash with money at the moment, but that invest very little in the capital market. Okay, they invest actually much lower than their, strategic asset allocation limits, for the capital market. And then we have domestic investors, that's the personal investors, who, because they have been significantly hurt during the 2008-2009 financial crisis, have left the market in large numbers, and many of them have not returned. So this is really the situation that the capital market in Nigeria is facing. Oil price is an important determinant of economic activity in Nigeria, because we are an oil producer, and the government fiscal policy is very much dependent on oil. But I think there are pools of autonomous funds within Nigeria today that, if they should allocate just a little more to the capital market, you can see a significantly much better performance in capital markets. So we are trying to now have those engagements, trying to talk to ourselves within the capital market, to say, what is it that we should do in terms of improving our investment vehicles, our investment products, so that pools of money like those in the pension fund industry are able to actually find value in the capital market. What is it that we need to do to attract back the investors, the personal investors that have left this market, and many of them have not returned? Remember, in the last 10 years, a significant number of young people have started economic lives, but many of them are not investing in this market. I was just talking about the average age of the CSCS client. So the average age of the person who holds shares in Nigeria is over 50 years old. So that is really a very, disturbing statistic, seeing that this is a very young country. We have a population that is predominantly young, but then we have investment in the capital market that is predominantly undertaken by people who are really almost past the age, of economic usefulness. So I think this is an opportunity for the market. If you can just make the right moves and attract back a small part of these investors who right now are not investing, in the market, you can really have a massive rebound in the fortunes of the capital market. And come to think of it, we have only two markets essentially in the financial sector. Okay, you have the yield curve. Okay, the shorter end of the yield curve is the money market. Yes. The longer end is the capital market. Now, this is the market that you and I and our children basically have to invest our savings, for use, in the future. So we do not have any other option than to really look at this market and then try to perfect, whatever is wrong with it, so that we can have a market that really is able to provide the kinds of savings investment that we need in order to provide for a rainy day. Okay, we have pensions. Pensions are meant to be invested for a very long time. You cannot invest pensions in the money market. You need the capital market to do that. So really, if we do not invest in our own market, if we allow the vagaries of foreign exchange that actually is the key determinant of, for the foreign investor who basically runs away from the market at the slightest possible hint of a foreign exchange difficulty, then our market will continue to suffer. But when when we know that we are investing for the long term and not for just, the next 6 months or the next 1 year, then you see that the capital market is really the market for us, and we need to do more to support that market. So we are engaging with operators, with the various capital market infrastructures, but also with policymakers and with pools of institutional investors to make sure that this message is passed along, and to make sure that this market comes back, and gets the local content, that is both local investors that are individuals and local investors that are institutionals, to really come back into the market, so that we can really move forward. And then we can use these pools of money to create the infrastructures that we need. We know how many children are now back in the country because their schools are closed in the countries where they are studying. Okay, if you had all these universities and colleges out here in Nigeria, and we really need to have more of this, kinds of things. We know how many people will have been in foreign hostels at the moment, but because of the pandemic and the difficulty of movement, most of them are here, and you can hardly find a hostel bed in places like Abuja or Lagos, because we are all using the limited medical facilities that we have. These are the kinds of things that we should use our money to invest in, so that this place becomes a destination, even for other people to come and enjoy these facilities, not that we just have a kind of one-way traffic of our people to other destinations where they go and enjoy these services.
Thank you so much, sir. I am happy you alluded to the PFAs and how it is that, because we all know the sacrifice made by our leaders and those who work tirelessly to launch the contributory pension scheme. And we know how successful it is today in terms of the size of the total contribution, except of course that we also are aware of the pain and frustration with the way that that contribution is being deployed. The idea was to create a large pool of long-term funds to go into key sectors of the economy and to help rebuild the economy. That is not happening. One of the major concerns that I hear from the PFAs is the absence of attractive asset classes, the absence of credible investment, infrastructure bonds, for instance. So I was going to ask you, how do regulators and like you work with other regulators and policymakers in government to crystallize these asset classes and bring them to the market?
Oh, thank you very much. I think this is a very interesting question. And this is a question that we have been really, trying to answer here, at the SEC. And the answer is simple. If you essentially match the requirements of investors, what do investors require? Investors require a good rate of return. Not even a high rate of return, but a good rate of return that compensates for the effects of inflation, okay, that is sustainable, and that they can, actually, invest, their monies, in over a long period and really see some kind of capital appreciation.
Yes, sir.
Now, the market, needs to have infrastructure, kind of funds that address the infrastructural needs, of the country. And we have two of them. I would love to be able to ride a train from Lagos to Abuja.
Yes.
Maybe during that process, maybe a 6-hour trip, reading a book or doing some kind of work, okay, which is something that you do actually in a lot of other countries today.
Yes.
In Nigeria, you still have to use either air transport or road transport to be able to move from Lagos to Abuja.
Yes.
If you can have a project that brings a rail line, between Lagos and Abuja, and between Abuja and other cities, you'll find that it will be really highly taken up. Right now, we have airlines that are not really the most reliable in terms of timing. Okay, if you have a train that can leave Lagos and arrive, say, before breakfast in Abuja, and you have one that leaves Abuja and arrives Lagos, before midnight, many people will just commute to Lagos for the day and go back.
That's right.
The same thing with hospitals. We pay a lot of money to go to foreign countries, check into a hospital. Of course, you have already paid, the cost of a visa, the cost of air ticket, the cost of hotels, just to go maybe for 2 days or 3 days to see a doctor. Okay, because you have some very important, procedure that needs to be done, and you probably do not have that facility, in Nigeria here. Now,
yes.
If we can deploy our assets to create these kinds of infrastructural projects, I mean, investors are willing to actually invest in this asset and get payment gradually over, the lives, of those projects. And this is what really happens. Hotels, nobody builds a hotel, just out of, pure cash. That is out of own money. People borrow, and people borrow because they know that the project that they wish to finance with this borrowing will bring returns that will more than compensate for what investors are looking for. Okay,
yes.
So I think what we need to do is to have these kinds of funds. And I'm happy to say we are already having market operators that have seen this opportunity and that are beginning to create these kinds of funds. But I will say that we need even more. We need even more of them. So we are working with different regulators to see how we can essentially provide the incentives that these kinds of fund managers, need to have, how we can craft regulation to make sure that investors' interests are well protected, how we can protect from overvaluation, of these funds, but these things, are necessary. But the good thing is that they are beginning to happen now.
Precisely, sir. Thank you so much, sir. Thank you. I think there will be a very significant role in this regard for policy making, because one challenge you have today is, or what is required would be to fast track the pace at which infrastructure is taken from the state and taken to the market. If you look at the plan to concession the airports, for instance, it's been on the drawing board for so long. If you look at the requirements for infrastructure concessioning, it's so long that without having to amend relevant laws and then maybe have an agency that is free, a government agency that is free to do this, we may continue to just spend a long time. Let me take you to one important area of discourse among investors in Nigeria, and it is the question of unclaimed dividend, which some have cited as a disincentive. What are you hoping to do to resolve all the issues around identity management so that this whole matter of unclaimed dividend does not remain a sore point in the market any longer?
Thank you, Frank, for this question. And I think it's really a disappointment that we have unclaimed dividends, on the scale that we have in this country. And we actually even do have unclaimed dividends on some relatively new issues of securities. This is really amazing. So we thought it was really a problem of the past, but you have new issues of securities that just came into the market not really long ago, but you already have unclaimed dividends, on those securities. So I think there is a fundamental problem, in Nigeria. And one is really this issue that you mentioned, identity management is very, very important. We are doing, a number of things, first of all, we have mandated all CMOs to update, their KYC information on their respective clients. We have also continued to engage with relevant agencies to harmonize identity management systems and processes within the market in line with the drive to create a seamless investor experience, for our, investors. And we also plan to liberate the BVN. The BVN is an identity management initiative that has had surprising impact, in this country. And remember, Frank, the capital market transaction starts from a bank account.
Yes.
If you don't have a bank account, you cannot actually buy anything in the capital market today.
Precisely.
And it also ends, the process ends in a bank account. So basically,
Yes.
when you get your dividends, when you get your distributions from any other investment that you buy, these distributions get you onto your bank account. So
Yes.
if that is the case, you then have one good infrastructure on which to really, put your identity management system. So we are working with the central bank and with the other agencies in the capital market to make sure that we have an identity management system that leverages the BVN that is unique in the capital market, so that you don't have to basically have different KYCs, with different registrars, with different stockbrokers. Okay, you have just one identity, and really that is me. If I come out on a Friday, it is me, Lamido Yuguda. If
Yes.
it is Monday, it is me. It's just because the day has changed. So the same thing, if I go into my bank, it is me. If I walk into my stockbroker's office, it should be me. It shouldn't be any different. So once you understand these principles, you find that it is possible to have a unique identity management, infrastructure, and a unique identity for each particular customer. So right now we are working on identities not only for the investors, but we're also working on identities for also the issuers and different other market operators. So these are still at an early stage. We're engaging the operators, discussing with them. We have seen different kinds of identity management approaches, but we're trying to harmonize them into one single one. And I can tell you that within the next 12 months, we will come up with something that I think the market will really applaud.
Thank you very much, DG. As we bring our conversation to a close, I think it would be unpardonable for me not to ask this question that relates to how we are all working together at a very difficult time in global history. The Capital Market Support Committee on COVID-19 has been working to help mobilize funds to support government efforts at combating the virus. Would you want to speak to this as a shining example of how private sector and public sector can collaborate at major intersections to deal with common threats?
This is the Capital Market Support Committee. It's an initiative of the capital market, and it's really just an attempt by the capital market to say we should not leave the government alone to fight this pandemic. We are all in it together, and we should all contribute in order to help the government and our citizens to really ward off the effects of this pandemic. And there was voluntary contributions from all capital market operators and from staff members, of respective capital market, operators and, the regulator, to say that, look, we are giving this out of our own free will to help the government to fight the pandemic. And we have done a lot in that respect. We have distributed ambulances, we have distributed face masks, infrared thermometers, name it, face masks, everything. And we have basically gone a step further to say we should establish a healthcare infrastructure fund that will actually provide the seed money for a fund that will provide healthcare facilities, in this country. Now, this fund is still in its infancy. It is on the drawing board. We are still working on the structure. Okay, following with the relevant details will be released to the market. But I think this is a very strong way. People did not look at profit in this case, because remember, a lot of capital market operators really suffered during this pandemic. But still, they gave out to make sure that the capital market is there to be counted. When the list of contributors to this, massive fund that is required to help Nigeria fight this pandemic, I mean, is actually, I mean, read out that the capital market is really there, very prominent. And I'm proud to say that, we are really very happy that we have done this, and the various agencies and government institutions that we gave out this, help to were actually very, very appreciative. And I think all Nigerians should really rise at a time like this to support the country. Government cannot do it alone.
Thank you so very much. My guest, ladies and gentlemen, has been Yuguda Lamido, Director General of the Nigerian Securities and Exchange Commission. Please help me in thanking him for his calm and illuminating responses to my question. We wish you well, sir. Thank you very much.
Thank you, Frank. I wish you a very good day.
Pleasure, sir. Thank you, sir. I'm sure we will be transiting, and my colleague Rolly will take over from here. I know that we will now be following with a presentation by Haruna Jallo Waziri, the CEO of the Central Securities Clearing Systems PLC, who will shortly take the podium to speak to the gathering.
Thank you, Publisher, Mr. Frank Aikpogun, and a big thank you to the Director General of the Securities and Exchange Commission, Mr. Lamido Yuguda. It was a highly engaging conversation, and we look forward to your plans on transforming the Securities and Exchange Commission. We would now be going for a 1-minute break, after which we will be going straight to the panel discussion, the first panel discussion for the day. Thank you.
For us, I think we've succeeded in setting up the right mix of people. After people, we have the right mix of processes as well. After processes, we set up, a bouquet of products. These products, you would agree with me, should be dynamic because we operate in an ever-evolving environment. After product, we looked at partnerships. For us, partnerships are very important. A business would never continue to be a going concern if you don't talk about profit. So I think that year on year, we've made decent profit. I must say to our staff that we are proud of you. You've been a good, addition to the family. And to our clients and other stakeholders out there, we say congratulations to you as well for partnering with us throughout this journey. We hope that as we move into the future, you will continue to partner with us. Congratulations, commercial partners.
At this point that we would not be taking the presentation from the CEO, CSCS, Mr. Haruna Jallo Waziri at this time. Rather, we will be proceeding to the first panel session where he would be able to share his plans for the CSCS with us in detail. We would like to encourage our audience to make use of the Slido feature in directing your questions to the speaker. We would, the hashtag for the Slido is BDCM, hashtag BDCM. We would also be sharing a poll with the audience shortly. It will be coming up on your screen. Please take a minute or two to answer the questions. At this point, I would like to hand over to the moderator for the first panel session, Ms. Omobolanle Adekoya. She is a partner at the PwC Nigeria. The first panel session is Row, Row, Row Your Boat, an investor's guide through choppy markets. We will now be handing over to Omobolanle. Over to you. Thank you.
Thank you, Rolly. It's a pleasure. It's a pleasure to be here and to be part of this wonderful occasion. A lot of things have been said so far. So before I go on, I would like to introduce our distinguished panelists for this particular session. We have 4 panelists. The first person, which we have already heard is around, is Mr. Haruna Jallo Waziri. He is the Managing Director and Chief Executive Officer of the Central Securities Clearing System PLC, and that's CSCS. He has 3 decades of experience around the capital market. He is a financial market expert, specializing in deal origination, investment manager, investment management, and his role as a CSSC PLC is to provide strategic direction to develop them in the 5 strategic pillars they have, which includes things around technology, includes things around customer satisfaction, various partnerships. Before joining the CSCS, he did, start his career at the NSC. So as we mentioned earlier, he is a seasoned financial capital market expert. In addition to that, he's worked at Afri Invest West Africa, which used to be SEC Trust. He has also worked at Kakawa Discount House. He was MD CEO of UBA Stockbrokers. So there's a lot of experience, and we're very happy to have you here with us to share your insights. He also sits on various boards, which include places like FSDH Merchant Bank, the Nigerian German Chemical PLC, Oakwood Protea Hotel, and and other boards. So you are very welcome, Mr. Haruna Jallo Waziri, to this panel. Welcome, sir. The next panelist I would like to introduce is Mr. Uche Val Obi, SAN. He is the managing partner of Alliance Law Firm. They are a capital market, investment, corporate finance, energy tax, and fintech firm. The firm is the current holder of the Best Banking and Finance Legal Team in Nigeria 2019. Congratulations for that. He also was one-time chairman of the Capital Market Solicitors Association and is presently the chairman of the International Trade Law Committee of the NBA section of Business Law. He's a notable contributor to the World Bank, and IMF Ease of Doing Business in Nigeria publications. You're very welcome, Mr. Uche Obi, SAN. We're very happy to have you here today from the managing partner of Alliance Law Firm. Well, good morning, sir. I think you're on mute, Mr. Obi. You're on mute. You might need to unmute.
Thank you very much.
Thank you. The third person I would like to introduce for our panel today is Miss Ete Ogun. You're very welcome, madam. Ete Ogun is the managing director of Ancoria Asset Management Limited. She used to be, she spent quite a number of years, at Ernst & Young. She has over 16 years experience working in these various areas. She's also got a banking and funds experience, following her career at Stanbic IBTC Asset Management as a portfolio and relationship manager, and then going through the ranks to become head of fund operations. Prior to that, she's also a member. She used to work at Planet Capital Asset Management, and she's also a chartered accountant like myself. So you're very welcome, Madam Ms. Ete Ogun. You're welcome to the panel today.
Thank you.
Thank you. And last but not the least, I'm very pleased to introduce Mr. Nnamdi Iwizu, who is the co-managing partner and executive director at Commercial Partners. He was the vice president and head of fixed income trading at Citibank Nigeria. He's worked in various areas dealing with helping with deals around the bond market, extensive debt securities experience, Eurobond securities experience. He has he has worked around on various deals around the world. He also has previously worked at Zenith Capital, which is now Phantom, as we all know, an investment banking subsidiary of Zenith Bank Group. He has various experiences working with Financial Dealers Market Association and being a contributor there and giving various insights. So we're very happy to have you as well, Mr. Nnamdi Iwizu. Welcome to the panel. As earlier mentioned by Rolly, my name is Bolanle Adekoya. I head the Capital Market Accounting Advisory Unit for PwC in West Africa, and I'm happy to be your moderator today. So before we go into our main crux of the discussion, we wanted to take some questions, but we'll start with the first one. So we're going to have a poll that we would like to sort of take. We've heard a lot of things in the from the previous distinguished speakers about the progress, or maybe not so much progress, that we would like to have made with regards to our capital market. But we know that these things are affected by a number of macroeconomic factors and some things around pricing. So the first poll that we would like to take, the first question for the poll is, will the recent shock reforms of electricity tariffs, so for example, we would have heard that the electricity distribution companies have moved their prices from 29 naira to 57 naira in some places. VAT increase moving from 5% to 7.5%, as well as the removal of petrol subsidy, which of course has caused petrol prices to skyrocket to between 160 and 162 around per liter around Nigeria. So you will see on your screen, do you think that this recent shock reform will be a net benefit for Nigerians in the long term? So your answer, please answer whether it's yes or no. So it will come up on your screen. Please answer yes or no to the poll that's coming up. Attendees can access the polls using the Slido BDCM. So there's the code BDCM on the slido.com. So remember hashtag BDCM, and then there is a website, slido.com, which will allow you to answer the poll. Please take a few seconds to just answer. So I'll ask the question again. Will the recent shock reforms around VAT increase the shock removal of subsidies, which is cost increase in petrol prices, as well as the significant increase in electric tariff? Will it be a net benefit to Nigeria? Please answer yes or no. Okay, so we'll take the results of the poll later on, but let's move into our discussion today around our panel. So the theme of this particular session is row your boat, an investor's guide to choppy waters. And the truth about it is that we have heard a lot of mixed information today about the different things that are happening. And with the panelists today, the first question I would like to ask each one of you is, these are uncertain times. Even before the pandemic, there was a lot of question about the fact that we had a very sluggish economy with growth struggling around 2%, Naira devaluation. There's been a reduction in FDI, foreign direct investment, of about 7% in the last, past few years that we've been working. Do you think, yes, and there, only 400 accounts, on the CSCS, with 150 million, sort of adults around of investment age. Do you think enough has been done to encourage all types of investors to take that leap into the capital markets? So I would like to, start with you, Mr. Waziri. What are your thoughts around that question?
Okay, thank you very much. I like the precedence of discussions before this hour, or rather, the precedence of speeches and opinions before this hour panel. But let me start by correcting some of the things I'm seeing on the chat and the things that have been mentioned. There are actually about 13.4 million accounts at the CSCS. Around 8.5 million are not have not done a KYC under a brokerage account. About 5 million of those accounts are under brokerage, just under 5 million. But what's interesting is that in the last 7 years, only 564,000 accounts have traded. So, we have a huge amount of, account holders who have created an account, who own shares, but are, if you like the word, dormant, are not active in the way that they trade. So that's the first thing I want to correct. Now, in terms of what I think around the structure of the market, and I always like to use the analogy of my teenage son, who, when I try to explain to him what happens or what I do on a daily basis in the market, and the thing that caught his attention was that, Dad, how can you have a T+3 environment? How can I sell my shares and not be able to access my money until 3 days after? Are you sure I'll be able to participate? And that kind of tells you, with the stats that the DJ had actually mentioned, where it's been, muted around the community, that there is the average age of a CSCS account holder is above 50. Maybe it's even higher. Now, what we should look at is also the velocity of new shareholders who come onto the platform and check their age. We're looking at that data. We'll make some pronouncements or announcements based on that. But by and large, what we need to do is to begin to look at what are the things or the hindrances that clog the whole market as a whole. So things like issuers who want to come and say, how long will it take for me from start to finish for me to raise capital? What's the alternative? So today an issuer can spend anything between 6 months to 1 year in order to raise capital in the capital market. While if he goes to a bank in 1 week, he can raise that money. So, those are the little things that, we have to look at from a process perspective, from a structural perspective, that, both from the investor side and from the issuer side, because the two have to come together for you to have a market, that we need to address. I like what the DG said and even what the CEO of the stock exchange had mentioned in his opening speech, that there is a wake-up call for us to take a look at the market structure, take a look at the way things are done, take a look at the processes that are required to begin to attract a situation where entrance and exit on our market should be simple, straightforward, and also exciting. Thank you.
Thank you, Mr. Waziri, for that. That's very interesting. Ms. Etel, will be interested to hear your thoughts around that, because you deal with investors on a daily basis. Do you think enough has been done? We talked about the barriers that Mr. Waziri has just talked about and hindrances. But what are your thoughts? Has enough been done? What else can be done?
So to be clear, there's always room for improvement. Have we done everything that we can? The answer is no. Have we done enough? No. But are we doing something? Yes. And everybody is doing something. So I will take it up from the SEC angle. There is some form of literacy program that SEC tries to do. So they try to engage clients enough that that there are certain things that when things happen on your accounts, you can go here. Their complaint framework, tries to sort that out. On the fund managers leg, we have the Fund Managers Association of Nigeria, which is like a pressure group, where it is that we're expected to come up with initiatives, discuss with the regulator on how to push this industry forward, make it better, more accessible to people. Having said that, I think that financial literacy we need to do more on financial literacy, because it will go a long way to ensure that these reforms that we're doing, they have the impacts that we desire. And it's across all cadres, for everyone. We need the financial literacy. That way people can begin to think about real solutions for the Nigerian market, the things that would impact and cause there to be a change, the sort of change that we need. So listening to the DG speak, I'm like, really a lot is being done on the ground. There's so many things being done, but the process, like Mr. Wazir has said, needs to be fine-tuned. A lot of clients complain that the bureaucracy involved is too much. And like you've said, the average age is about 50. A lot of people who want to trade are above that age, but when they come up with the bureaucracies, they're like, I don't need this, I will just leave it, right? Because they don't need it. But we need them to trade, to make the market active, so that young people can see that there are benefits within and they can come in. So I think it's a collective thing. It's not the best yet. There is a lot of room for improvement, but kudos for the people who are working in the background to ensure that these things are happening. Thank you.
Thank you. Mr. Obi, you know, as a lawyer and with what your firm does, you actually work from the investee company side, so you've seen a lot of it. So it'd be interesting to hear your thoughts from the investee company side on whether there's been enough done to encourage investors, because you're working with people who, from their point of view as well, want to see a change, want to see speed, want some of these barriers to go down, and probably want to also get access to more investor types. So what are your thoughts? Has enough been done? And what are your thoughts about what else can be done?
Thank you for that question, Bolanle. What I appreciate. We all recall that prior to COVID-19 pandemic, oil prices were relatively leading to a downward review of the nation's budget. That's a pointer to where we are. Under such uncertain scenarios, investors seem to hold back and trade more carefully. When such situation is further compounded by an unprecedented pandemic that literally shut down global economy and triggered general recession across the country, would naturally, very, very steep. And investors will not have any option than not being bullish anymore.
Mr. Uchiobi, I don't know if it's my next one. I can't, your line has frozen. Okay, so whilst we wait for him to come back on, can I okay, sir, we lost you for a little some seconds there.
All right,
Can you hear me?
Yes, I can hear you. Can you hear me now?
Okay, yes,
all
sir.
Right. Yes, I was simply saying that when such a situation is further compounded by an unprecedented pandemic,
okay. Okay, that's fine. Mr. Iwizu, Mr. Nnamdi Iwizu, with commercial partners, I mean, similar to what we have heard today, I'm sure that you are probably seeing a change in the type of investors that you're seeing. So it would be good to hear your thoughts as well on whether enough has been done and whether there are some untapped opportunities that we haven't sort of looked at.
Thanks for the question. So with regards to opportunities, I think that we are still basically suffering from the 2007-2008 stock market crash. And I think that in the psyche of a lot of the younger ones, for instance, that they are still reeling from the losses from back then. I think that a lot more can be done around basically trying to sensitize the investing public on the advantage of the stock market, on the fact that it's a long-term investment. Because I see that what you see with a lot of investors is that basically they're all thinking short-term. People want to go into, you have people who come in and they say to you, oh, so I need to possibly put money aside for 90 days, and I'd like to invest in the stock market. And you say to them, look, stock market is more of a long-term play, not a short-term play. So we on our own always try to basically educate investors around this. And I think that this is something that would be good if we had the NSE and other capital market operators basically trying to do a bit more work around this. We need to shift the paradigm of your average Nigerian investor of just short-term investments basically to long-term. When we start to do that, then we will start to see a lot more traction with regards to the capital markets. And then also, you possibly also start to see the age of the investors come down. I can bet a lot of those retail investors over the age of 50, and most of the people who invested years ago, it will be interesting to see what the age of the investors over the last, say, 3 or 4 years have been, to see if you're getting a bit of younger people coming to the market. But a lot needs to be done around sensitizing them and having a paradigm change, a paradigm shift around the whole investment horizon, investment tenor, risk appetite and all. So I think there's a lot of work to be done there, even though I must say that the NSC has tried so far in terms of trying to boost investor sentiments with regards to the capital markets. Thank you.
A lot has been said there, and it's very important as well that we do give kudos to the NSC as well as the sector. What some of the things that they are working on, as we're seeing that develop over time, and in the long run it will pay off. I would like to go back to Mr. Waziri. I mean, one of the things I would like us to do is to give you an opportunity to talk about some of the initiatives that the CSCS is working on, because at the end of the day, the CSCS has a very significant role because you're the one sort of managing the ecosystem for the investors. You keep the investor account. When there are switches sort of going on, these things have to go through yourself. Earlier on, you had mentioned about, we had heard things about looking at things around KYC. Earlier on, we heard the DG talk about unclaimed dividends. There are a number of things that are going on. So, Mr. Waziri, it would be good to sort of find out what are the initiatives the CSCS is working on to try and improve the active participation of investors in your current ecosystem. You already gave us some numbers about the fact that even though you have 13 million accounts, only 564,000 of them are currently active, while some other people think it's lower than that. Over to you, sir.
All right, thank you very much. So let me talk before I talk about because there's synergy between what we're doing and what we're seeing in the market. When the market was booming in 2006, 2007, 2008, I didn't see any investor education beyond that. The market was where you could put money and make some more money. All right. There are 3 stages in the life of CSCS that we saw traction in the number of accounts that were opened. Number 1 was when the federal government was doing privatization, based on the TCPC guidelines. We saw accounts being opened at the CSCS jump from, I think, 1.6 million to about 5 million. The second stage was when the banks were doing the banking consolidation, where banks were raising capital, building their balance sheet. And we saw the jump between that 4.5 million to about 9 million. Now, these are 2 instances of shocks that occurred in the market. 1 was privatization, 2 was banks raising capital. And that was where we saw the biggest jump in terms of account open at the CSCS. So we need to have those kinds of shocks in the market to bring people out of their comfort. Now, what do we need to do? Number 1 that I think, which is a focus to us, is to begin to look at our operations from end to end, improve on the the processes. So if something takes us 1 week to do, can we bring it to 1 day? If something takes us 1 day to do, can we make it 1 hour? And if it's 1 hour, can we make it a minute? If it's a minute, can we make it instant? And so we've, in the last 3 years, invested heavily in technology to the extent that we wanted to deal with the issue of KYC. So today, if you want to open accounts in the capital markets, you go to a broker. The broker gives you a form, you fill, he goes in and enter manually the details of what you've given him. And then he opens our own portal and manually enters it. 2 processes that are likely to bring error. 1, he's putting on his own. 2, he's putting on our own. So a number can be 0820 300, blah, 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 blah. And then he miss a 0 or something. It's not 11 digits, it's 7. He puts number 5, Bangoshe Street, and then says Anambra State by mistake. So what we are doing to eliminate that is we've built an API with the other management system providers at the brokerage end, such that at any point in time you're opening an account, it goes seamlessly into our systems. But before we accept it, we do 3 validations. 1, are all the fields complete and what is expected to be there? 2, is your BVN correct? 3, is your bank account correct? 4, if you have a CHN number already, we'll have to validate that. So what that does is that it reduces the amount of garbage that initially could occur when we take in data. Because whatever data we have is what data we give to registrars that they will use to pay you dividend or keep your records or do any corporate action as it is. We felt that was very important from what even the DG said around KYC and identity management. That's key to what we are doing. 2 is that, if you look at how we operate today in terms of the efficiencies within the market, we have built capacity now to be able to do T+1. In fact, we could do T+0. So our systems now are ready. We have to look at what market is doing for us to take it to that level. From a risk management perspective, as you know, earlier this year, late last year, Thomas Murray came and did an evaluation of the CSCS, and we're able to move our rating from A to A+. I think there are only 2 other CSDs in Africa that actually have that kind of rating. And that's an indication of all of the work we're doing within the risk management perspective, from operations to capital to processes to everything, to ensure that we have a credible market. From a partnership perspective, we realize that as a market infrastructure, we touch on various entities, and we felt that rather than sit in our offices and consume everything, we now actually effectively go out there to talk to the custodians, to the registrars, to the markets themselves, to even regulators, to say, okay, as a market infrastructure, this is what we're seeing. How can we help you operate better? And how can we make the market better? So that partnership is ongoing. We have MOUs or agreements, partnerships that we sign both locally and internationally to be able to say, what are the things you need us to do? How can we make it better? And that constraint is very important, like the SEC DG said, amongst many things that they want to partner with market to ensure that the market grows. So from operations to technology to partnerships, are the key areas that we currently are investing in. As you know, the CSCS is a market infrastructure, it's an iceberg, all right? You don't see what goes on under, you just see something at the top. And I can tell you, in the last 3 years, a lot of work has gone in. And then the APIs we're building also, we're giving it out to not just brokers, but other data consumers, even custodians, and of course, the registrars are, entirely coupled with us through a system called Reg Connect, which we built. It's also a validation system where we exchange data between us and them. And today is an STP system that's up and running. And even that ensures that whatever data we give them is validated. Whatever data they give us before we consume it is also validated. So those are the few, what I call little things, if you like, from an iceberg perspective that are very obvious in the market. Thank you.
Thank you. It's great to hear some of these initiatives, and to be honest, even I'm guessing we're also using some of the case studies from other parts of the world that's happening. So it's very good to hear, and congratulations on your improved rating as well. I will come back to you. There's another question I want to ask you, but I'll come back to you. Mr. Uchobi, I would like to come back to you and just sort of, you talked a little bit about some of the improvements that you would like to see, but I want to focus a little bit about the regulatory landscape. So earlier on, I'm sure we heard Eric's comments around what has changed with regards to the reason.
By the way, observing the way they have been reviewing and issuing regulations and help sustain investor confidence in our market. Other investment exchanges, apart from the SEC, apart from the Nigerian Stock Exchange, have equally been doing that. They've been quite proactive in rulemaking and other market development initiatives. Now, as we know, the SEC has a 10-year master plan, which have been mentioned by the DG when I was speaking. It was, and initially it was a 2010 to 2020, but later on it became 2015 to 2025. And but with what has been happening of late, I rather would think that that document needs to be further revised in the light of present realities. There was also another report that I would like the SEC to look into and other market operators. And that is the report from the Emerging Capital Market Task Force Initiative. Now, that was a collaboration between the Foreign and Commonwealth Office of the United Kingdom, driven by the former Lord Mayor of the City of London, and the Nigerian capital markets. In this, on our own side here, Mr. Aiboje Ike Imokude led the Nigerian team. And the essence of that was to look at the rules and procedures in the UK and in Nigeria, streamline them in such a way as to encourage free flow of investments between London and Abuja. And that report is important. Though it's a private sector initiative, it had the support of the public sector at the time the work had happened. And lawyers in Nigeria also worked with their counterpart drawn from the Law Society of England and Wales, and to streamline all this. Now, what am I saying? The capital market in Nigeria cannot operate in isolation with what is obtainable in elsewhere. And we have moved from the old standpoint of focusing on domestic transactions to now talk about cross-border transactions. We're talking about things like dual listings of shares of companies on investment exchanges in Nigeria and abroad. We also will be looking at things like cross-border mergers and acquisition. Now, if you go to England and look at their rules and procedures, you find out that there will be areas of conflict with what we have here in Nigeria. And that will almost like stall the progress of such important transactions that can move a market forward. So that report I'm referring to had helped in understanding the nuances in the two places and made recommendations on how to harmonize to move a market forward. We need that because most times foreign institutional investors look at quite a lot of things. And if those structures are not there, you find their play in our market will be limited. And any slight disruption, they exit. The hedge funds will go, every other fund will go. And then we're just left with what we have here in our domestic market, which does not have the absorption capacity to even take on some of the credible issues that may happen, assuming we decide to list energy companies, oil and gas companies, power companies. There's a question about the absorption capacity of our market in terms of liquidity. So These are some of the things we have to look to further internationalize our market. Now, back to what we're talking about, regulations. I can point at quite a number of introductions and rules brought in lately that have helped. We have the e-dividend mandates management system, the direct cash settlement, and multiple subscription services option. We have the preservation of investors' confidence through the Nigerian Investment Protection Fund. We equally have the important rule that came out in 2019, and I commend SEC for this, where they say all funds are now to be benchmarked against a recognized index. Now, this helps to keep our fund managers in check. They need to work well, and they're knowing too well that they are being assessed by world best practice standard. Then I could also talk about related party transactions, which have been eased a bit, but subject to certain rules like SEC permissions. If you divest related party transactions, you will find out that some companies, their securities will not even be traded that much, because sometimes those people who are related parties believe in those stocks and could go extra mile to do that. I could also talk about the introduction of market makers, but we don't think that the necessary incentive required to enable them make markets have been actually been introduced. I could go on and on. For instance, the requirement for trustees to consent to certain transactions is equally pivotal, which means fund managers don't even have the absolute say anymore. They're accountable.
Okay. Mr. Obi, I think your line has frozen again, but thank you for that. I mean, there's a lot that you have sort of shared with us around the work that was done to just sort of highlight on how different some of our regulations are, and how we can streamline it to what's going on. Because the truth about it is that we are in a global economy, and we need to follow suit and ensure that we are able to meet those standards. Because at the end of the day, apart from our local investors, we are looking for opportunities that other foreign investors can bring in addition to the other initiatives that the SEC has brought in the last 1 year that is helping to protect investor value, as well as even the investee company value. Thank you for that.
Permit me to complete this last statement I was trying to make. I said that apart from their roles as gatekeepers, there should be a paradigm shift right now towards transaction facilitators. Certain transactions would never ever happen in this country, except this approach is adopted. That is the only way novel transactions can happen. We have some exotic transactions that are still novel coming up this way. Things like cross-border mergers and acquisition, for instance. So we need, because if we don't allow ourselves to be guided by best practice and still hold to what we have as our rules, it will never develop, and such transactions will never happen. So the SEC management, who I believe from what I've heard the DG said now, they are willing to open this market the more, should embrace that. Where there are no rules in Nigeria, they should allow transactions to happen insofar as it accords with best practice. Because we cannot have all the rules in place before allowing certain transactions. As a matter of fact, those transactions help us to define the rules. So that is my contribution to this. Thank you very much.
Thank you, sir. Thank you for that. And that last question actually helps move me on to a question that I actually have for Ms. Ogun around the appetite of investors and maybe a shift in the type of investment opportunities that you're seeing. The risk appetite for various investors is probably changing. So to you, Ms. Ogun, given what your organization and the role of your organization in offering opportunities to different investor types and profiles, have you seen a shift in the type of products that people are interested in, or even the opportunities that they're going for, whether it's locally or internationally, whether it's Africa, so whether you're on the frontier market or emerging markets, or even in the international world? It'd be good to sort of hear from you what type of products and investment opportunities are becoming more popular.
Thank you very much, Bolanle. Nice question to ask. So I'll talk about my investors in two categories. In terms of what the HNIs and institutional investors have been searching for in the last maybe 18 months is things other than the traditional asset classes. So we've thought about things like the Euro bonds, things like structured products around certain developments, things that are not typical as we've always seen. So yes, in terms of how the transactions flow come, they would come through the fixed term investment, but the underlying instruments are totally different. The structure of the transactions are different. And more and more investors are looking out for good opportunities for return. So they want to know, can we trade outside the country? Can we do things outside the country? These cross-border engagements that Mr. Obi was talking about is something that they're being particular about. And this we find on the investor, so the HNI and institutional investor leg. I will then come back to the retail investor who is not so savvy. Now, they in themselves they are still interested in in what we call the traditional, but you then have to do more education as to asset allocation for them. So it's been a different mix. It's been a mix, really. For the HNIs and institutional investors, they're looking at what else can I do? I mean, all of this, what is the new thing that I can do? And so you have to come up with products that are structured for them in particular, because they understand risk and they understand the reward that comes with the sort of risk you take. So it's how you build the structure around it that gets them interested. So on that beat, we have those people who, yes, are looking for new products and things. But on the other beat, for more the average retail investor, they are not fully sensitized on what the opportunities in the market are currently. And this is the reason why I think that financial literacy, we need to keep at it, because it really would help deepen the market. So we talk about the young people, for instance. Every time I have an engagement with young people, I try to preach investing in shares. Even if you don't go in directly, go through a mutual fund that is an equity fund. That way you can save over a long period of time, because it's a good store of value for them because of the age that they're in. And so a lot of people have been lukewarm to it, but I find that the more education that I do about it, the more people are receptive towards it. So yes, across board it's been different, mixed, because the HNIs and institutional investors want something, but then the other people want other things. Thank you.
Thank you. That's interesting. Here, you talked about the different categories of investors. Mr. Iwizu, it would be good to hear your thoughts, whether you're seeing something similar. The other issue around that I would like you to talk about is the fact that with the way our macroeconomic factors have such a significant impact on asset value and return. So, for example, our inflation is quite high. We're seeing inflation of 12.8%. It's likely to go up even more now that we have, some of the shocks around petrol prices and electricity tariffs and, other things that are going on. So it'd be good to sort of hear, your thoughts on Mr. Ogun's response, whether you're also seeing some of these type of things, and if you're seeing something similar. And then in addition to that, what are you telling your investors that despite this risk or the fear that you can see things going there's still opportunities that they can take advantage of. So to you, Mr. Izu.
Interesting question. So with regards to investor type, or with regards to literacy and financial literacy, I've always believed that it's a very important point, and something that capital market operators need to ensure that they themselves undertake. Now, if you were to look at the fact that as a capital market operator, the more investment savvy your clients are, then you realize that the more products you can sell to them, and the better they understand the market, the more willing they are to get into that market and to take on transactions in that market. So definitely, financial literacy would definitely help market development and definitely help increase cross-selling different products to your clients. Now, with regards to capital markets and what we see, I mean, in spite of the numerous challenges that have held the capital market down over the years, we still think that you always see opportunities in the market. There are always pocket opportunities. If you look at the Nigerian equities market, for instance, you most likely say, look, it's currently cheap. If I look at it from a valuation perspective, looking at price earnings compared to other frontier markets. So Nigeria is maybe like 9 times when you're looking at price earning versus countries like Kenya, which are like 12 times, or South Africa, which are about 17 times when you're looking at price to earnings. If you also to look at the stock market, if you look at where some stocks went, how low they went during this COVID crisis and the shutdown, like I had mentioned earlier, some stocks have done, well, you have a near-met, especially if you look at the pharmaceutical sector, that have done astoundingly well. Near-met has done about 200% from its lows around March this year, March, April. Look at Fitsin, you look at the Skyway, look at Cornerstone. All those are all stocks who have done roughly about 50%. So if you're looking at it from that perspective, with regards to investors, if your investors are savvy and are, financially literate and have been educated properly, they would also see these opportunities. If they were to invest with funds who are also experienced and know what they're doing, then those funds would have been able to help them get better returns by tapping into these various opportunities. Even if you were to look at dividend yield, so let's even look at some of the popular names that you have in the sector. You look at the likes of Zenith Bank with dividend yield of over 19%, or you look at maybe Dangote Cement over 12%. If you compare this with your low yields that you have in the fixed income market, if you look at 1-year treasury bills where you're getting roughly about 3% plus in terms of your yield for 1 year, or maybe 3.5, and you're saying to yourself, okay, look, if I were to invest long term in Zenith Bank, and my dividend yield now, which most of the banks, most organizations try to keep steady, is about 19.3. So yes, I might have some price volatility, but then again, we're talking about over 19% yield versus 3% yield over a 1-year period, and so some possibility of capital appreciation. So I think the major thing would be to continue to educate the investors and let them know that there are still opportunities out there, be it in the equities market or capital markets. Even if you were to look at the fixed income side of the market, also bond side of the market, we had seen quite some aggressive appreciation in prices. Yields have dropped. If your clients had come in much earlier, by now they would have been smiling to the bank, considering the fact that yields have dropped and prices have really jumped up and moved up. So I think that it's not all doom and gloom. I think they still have quite a number of opportunities, even till date. If the investors don't know how to go about doing it, then what they need to do will be to talk to the experts who can point them in the right direction, or invest in various funds that can help you maximize your returns on these various various platforms. And for even those who are a lot more savvy, you can even start looking at things like the derivative market and trying to see how you can get some value from those markets also.
That all these things would actually help deepen our market, because the more market activity that we have, the deeper the market is. And in addition to that, some of the things around interest rates and yields that we're looking at will also move and help, and also open up us to the world. Because if you look at other markets, people are work on trends. We know that there's a sort of a cycle of risk and return that that sort of happens, and we need to do that. So thank you for that. I would like to go back to Mr. Waziri. You talked a lot about some of the initiatives that the doing. One of the comments that I sometimes get from some of my clients is the fact that they say, we know the CSCS is there, we know the important role they play, but sometimes it's difficult to even find information or know what is happening. Can you just share a few tips of how we can help your ecosystem and the individuals that sort of want, especially on the individual investors, so those not using brokers, on how they can get on board and sort of take advantage of some of the initiatives that you are doing?
Thank you very much, Bolali. I get to hear this everywhere I go. We need to open offices in Port Harcourt, come to Jos, go to Enugu, and all of that. But when you are serving 13 million customers, you're not likely to serve them using brick and mortar. You've got to onboard them onto a platform that they can actually do things through self-service. We can't put 1 million people to serve 13 million people. We can't open branches everywhere. Now, but our shareholders, as you know, are typically north of 50. Many are retired, many are semi-retired. And so the process of going to the CSCS office is a routine for them. Okay? And because of that, they've gotten so used to coming to talk to human beings for them to try and walk through their problems. We've really enhanced our website, and I beckon you to now go there, www.cscs.ng. There's an investor section there. There is a broker portal. There is a registrar portal. There's a custodial portal. There is, an issuer portal. Now, for the investor portal, there are many things you could do. There's a form you can fill online to make a request of whatever you want to do. You'll get an instant notification around that we received your email and that will process it. But I always tell people it's easier. We have a web chat format there that's been run by a mayor. If you go there right now, you see the live chats. Make an inquiry, you get instant responses and all of that. Secondly, you can call our call center. We have the call center open between 8 and 5. We're trying to ramp it up to 12 hours and then take it to 18. So far, it's still, in development form. So multiple channels. We have an app. You could download the app and try and see what you can get. There's a search engine which should come on in version 2, which should be launched sometime in the next couple of weeks. That would allow you to do a search, just like you have your e-dividend, where you search and say, okay, I have this number of shares, even without registering or even without us validating certain things. So there are multiple channels that you can, use to reach us rather than come to us physically. The contact center is there. The web chat format is there. There's email. There's the website itself. So you don't really have to come to us. Many of those things, especially with this pandemic that has taught us that things can be done without you physically being there, kind of like makes sense. So to be honest, I think we have to wean people off coming to a physical environment to do things when we can move them up to a channel where they can have self-service, download reports, and all of that. So that has been our focus from an investment perspective. I think that's the way to do it. I don't see how Amazon is going to take complaints from all of its clients. There has to be a channel that is effective, that can solve the problem without having to talk to human beings. Where you need to, call center is there and they can actually assist. Thank you, Bolani.
Thank you, Mr. Waziri. So hopefully listeners have heard that, and also just sort of encourage them to make use of the electronic channels that are available and the upcoming technologies that are on. So there are a number of questions that have come in from the participants, and one of it I would like to actually address to Ms. Ogun, Ms. Ete Ogun, and the reason for that. So the question here, there are two of them, and I think they're quite similar. The first one is, what do you think about alternative investments in Nigeria? Are they viable? I know that, Ms. Ogun, you had mentioned the fact that a lot of it, if you look at the different types of investors, so the HN investors versus the individual investors, a lot of it has to do with level of knowledge. But let's think about it. Are they really viable? Those type of alternative investments in Nigeria, are they viable given the risk around things like our currency, given the risk around things like our underlying stock? Ms. Ogun, what are your thoughts about it? Can you just give us a quick answer on that?
Thank you, Bolanle. Are they viable? Yes, they are viable. Because if they weren't, they wouldn't, the need for them wouldn't have risen in the last couple of years. So yes, they are viable. In terms of our currency devaluation and all of the issues that we've had, it is still safe to say that this country is a place of opportunities. And now, as capital market operators, we have to ensure that we deepen the market so that people become more comfortable to come into it. We have to deepen the trust that people have in our market so that people are open to coming into the market. But yes, they're viable. And they would address, so in terms of return, in terms of sustainability, those things will address the challenges of devaluation and return that you're asking, if indeed now, based on the happenings, if it will be worth it. But yes, it is always worth it, because the return that you get from doing these things over the period of time will ensure that the valuation and other things are taken care of. More importantly, though, is to say that we need to get into a mindset where we have patient capital. So when I say patient capital, I mean capital that can go on for years. So if we look at the industrialization of other countries, we will see that all their steel, all their rails, all those things that aid development, they are things that they invest in for a long period of times, and you get return over specific period of times. As a people, we need to get into those mindsets that when we do those sort of investments, we don't get out in 6 months or in 9 months or in 1 year. Those sort of investments are for capital market. Those sort of timelines, those sort of insistence are on money market investments. Once we want alternative investment, alternative asset classes, we must be patient enough to understand that time has to pass. The money has to work to produce things that will bring valuable opportunities, and then would bring, in turn, bring good returns to clients. And that's why, tie into the conversation around infrastructure. A lot of these things can be gotten around infrastructure. We have the numbers. Hopefully we would have the monies to match, and we can create a synergy between public and private partnership. And I think that if it has worked everywhere else, we just have to fine tune it to Nigeria's peculiar market, and it will work for us also. So yes, it's viable as long as we put the right things in place. Thank you.
Thank you for that. Mr. Iwuzu, so I have another question here, which is actually very similar to the question I asked you about our deepening our markets and effects of macroeconomic factors. However, Mr. Iwuzu, when you were answering your question, you were talking a lot about the returns around the traditional sort of, we know the financial services companies, the big FMCG groups that are doing well. So the here is asking that if we exclude these banking stocks as well as this big, corporate, will our market still be deep? What is going to happen? Is it still possible? Because the truth about it is that it currently seems that the market offerings are limited. So it'd be interested to hear your thoughts around that, Mr. Easy.
Okay, so yes, I agree that if you were to remove some of the big names that you have, for instance, in the equities market, that the offerings will be limited. If you look at the fact that between MTN and Dangote, you most probably have a big chunk of the market cap basically filter away. So, I mean, I mentioned some small stock that had done pretty well, but I guess the question will be what kind of liquidity do you get to see in those stocks? So if you had a 1 billion to invest, for instance, would one have been able to put that money in a near net, for instance, and be comfortable that when they need to get out, that they would see, they would be able to. And the truth about it is most probably not. So, but you see, I talked about derivatives earlier on. We're talking about alternative investments, which I think is an area that we need to grow. But to get those things working very well, you need to get the baseline market working well, first of all. So most derivatives, for instance, be it FX, be it equity, whatever it is, always more or less depends on interest rates. For instance, if you're doing an equity derivatives, you're still going to use borrow money to do that, and you're going to have to price in the cost of your funds. So as long as you continue to have extreme volatility in the interest rate market, the limit to which you can grow a lot of these alternative investments and others than derivatives, other investment options will still be a bit limited. We need to see some sort of stability from the interest rate side. If, for instance, you're planning to do, let's even look at an interest rate swap, for instance, and you're planning to do something like that, and you're planning to switch floating for fixed, and you plan that your floating rate is going to be, say, 6%, and for some reason, the rate jumped to like 30 or 40%, you're going to lose a lot of money. And then tomorrow, somebody else comes and says, well, let's have some other structure that's, basically around having to do floating versus fixed. You'll be reluctant to. So we need to try and get the underlying market, get the mainstream market working and functioning pretty well. We need to get investor confidence working very well there. Then when that is done, then we can see a huge growth in the alternative investment market, and also we start to see a huge growth in derivatives. So yes, for instance, if someone comes and wants to do large size and MTN, and I want to do, for instance, something trade around the NSE, and you're looking at it and saying to yourself, look, if Dangote and MTN were to go down, it's almost impossible for the index to move up. And just those two stocks drop in terms of price, the rest of the index will find it difficult to actually move up, right, at the end of the day. Then somebody who's coming in and who's trying to create a product trading off the index would struggle a little bit, because those two particular stocks would more or less help point the direction of the index as a whole. So definitely you need to have a lot more large cap stock, for instance, coming into the equities market, so that you don't get to feel the impact so much of a movement or a move in one or two large cap stocks that you have currently, and they being the ones that more or less help drive the direction of the market as a whole. And then, like I said earlier, we need to have a bit more stability around the underlying products that, derivative basically derives its value from something else. So all those benchmarks that we use, right, to derive the value of derivatives or your alternative investments need to have some sort of stability so people can plan. So I say to myself, okay, so I'm doing a 1 year structure, and I need to have an idea what rates are going to be over the next 1 year, and I can't even predict rates over a 2 or 3 month period. Then how am I going to be able to come out and end up being able to package this transaction and package these and store them to clients, right? So it becomes a bit of a tough one. So, but we still need to find a way, I guess, to make the best of where we find ourselves and try and see what we can do within the confines of the economy that we see.
Okay, thank you for that. I mean, we've run out of time now. I would really like to thank our panelists for their insights. I'm sure the participants have also learned a lot and sort of just find out what is going on. I mean, one of the other alternative events that we know that we've seen has become popular is some socially responsible investments around ESG as well. So those are some of the, so green bonds and things that sort of happen. So those are the other areas that we're also seeing happening as well. So thank you so much to Mr. Waziri, Mr. Obi, Mr. We really appreciate your insights. We thank you to the participants as well for their questions. To just sort of end, it would be good to sort of have one more poll, because one of the things that we know that the NSC has worked on is around the growth sector window. So the last poll that we're going to be taking, which you can also take part in your slido.com window when it comes up, is the second question is: the growth sector window on the NSC was conceived to target SMEs for listing. What factors have held back SME IPOs? I know earlier on Mr. Aja had already mentioned around the threshold of 50 million naira. So there are a few things here. Can you just choose the option 1 to 4? First option is cumbersome reporting requirements, fear of loss of control, illiquidity of penny stocks, or few stories of sustained successes of NSCs. Of investee companies on the NSC. So please make use of the poll that we come to the Slido. In the meantime, I'd like to hand over to the Business Day representative. Thank you all and have a good day. Thank you.
Thank you, Bolale.
Thank you.
Thank you.
A big thank you to our distinguished panelists and speaker and moderator, Omobolanle, for your insightful contributions on this panel discussion. Thank you. Mr. Haruna Jallo Waziri, CEO of CSCS, Mr. Nnamdi Wezu, Co-Managing Partner, Commercial Partner, Ms. Ete Ogun, Managing Director, Ankoria Asset Management, and Mr. Uche Val Obi San, Managing Partner of Ankoria Alliance LP. We would now be moving on to the next presentation from Mr. Guy Satoriski, Head Research at Coronation Asset Management. He's going to be speaking on the topic, Rediscovering Risk, Not So Bad After All. When we come back from this presentation, we will announce the polls taken during the first panel session. Thank you. Over to you, Mr. Guy.
Okay, thank you very much. Is it possible to start my video and then am I allowed to share the presentation that way?
Please go ahead.
Okay. Well, first, let me say a big thank you to Business Day and the Nigerian Stock Exchange, particularly to Mr. Frank Ibogun for inviting us to contribute today, and we're very grateful for the opportunity. So I've been asked to give a presentation of about 15 minutes in length. And then in exchange, I was given a difficult subject, so this will be fun. Risk, not so bad after all. And I think something that is very interesting that's coming up through the discussion today is this word guide and guidance. Panel number 1 was an investor's guide through choppy choppy markets. And what that means is that we are not sure about the future, and we're not certain about that, and we want to learn. And I would say that what we're really trying to strive for is risk management, and that's what this presentation is about. Okay, so a sneak preview of what I'm going to talk about. There are 6 slides here. First one is called Goodbye to Easy Risk-Free Returns for Now. Money migrates, where's it going? The rise of managed funds, or as we usually call them, collective investment schemes, although that seems a bit old-fashioned. Don't forget how the pension fund started. Rates down and bond prices up means risk. And my final slide, my advice to diversify, even if that means buying equities. So this is sort of possibly my second favorite chart of my whole deck, and I've got sort of hundreds and hundreds of charts that go into various presentations. And it says that we've been getting a good risk-free return. This is actually a chart of T-bill rates over 10 years. And for most of that time, you got close to 14% back from your investment in T-bills. And that's really huge. That's more than 2.5 percentage points over average inflation. So the business of investing over this period has actually been very straightforward. Stick your money in T-bills, you'll be fine. But clearly, those rates were not available in 2010, 10 years ago, as you can see from the chart, and they're not available now, and they haven't actually been available since October of last year. And you know that inflation is 12.82% for July. So the rates that you get are very, very poor. And this could be that rates will just go up one day and we'll be back to normal and we'll have a nice risk-free return from T-bills, or it could be something more structural, which I suspect may be the case, in which case we need to diversify and take some risk. So one of the consequences of that, we're a little bit more sophisticated, they bought T-bills, and if they're much more sophisticated than that, they bought equities and then found out that equities could go down as well as up. So it all made perfect sense. Most people had a store of value in their bank accounts and also in their pension funds if they were in full-time employment. But obviously, several things have happened in the past year or maybe 18 months to change all that. One is that the loan-to-deposit ratio has been introduced. Banks have to lend 65% of their deposits as loans. And then there's the cash reserve requirement too, which is the highest cash reserve requirement in the world. And banks have to put a large proportion of their cash with the central bank. Result is that rates on time deposits and saving deposits have crashed, and you really don't know what to do with your money. So where has that money gone? And if you can see the next slide, the money's gone into managed funds. So if I said the first slide was had my second favorite chart, this is my favorite chart. And what it shows is, it goes back to January 2012, and it shows the rates you can get on a T-bill on the dotted line, and then on the sort of hashed line, you've got the assets under management of Nigerian managed funds. And as you can see, they've been shooting up. And it really is a growth industry. And this is where at least some of that money is going. Investors are now getting into the managed funds. Just a few stats. First is that the volume of money held in fixed income funds rose by 59% in the first 6 months of this year. Volume of money held in money market funds rose by 11% in the first 6 months of this year. And actually the 3-year growth rates and 4-year growth rates are extremely good as well. And as you might expect, quite a lot of money has gone into dollar bond funds as well. what's happening on the regulatory side is also very interesting. The SEC is doing a massive amount of work to prepare the ground for the growth of the fund management industry. And this formed part of a very large document they put out in December of last year, and we all have to comply by the end of this month. So we're very busy doing that. Now, another point to make is that this is 1/10 the size of the pension funds, but it is growing fast. And the next thing to say is about the arrival of tech. And the point was made by the Director General of the SEC in the first address that we had, that there is a sort of middle-aged market, perhaps, of people going into the stock market or sort of individual accounts active in the stock market. Well, with tech, it's completely different. You're getting very young people who expect to get their money in and out of their fund in a matter of hours, to get confirms in hours, and they're very active, and it's a very competitive market because they're comparing a great deal across funds and what they offer, and this is completely different. So this is quite an exciting space to be in. Now, 1.1 trillion is not a huge amount of money, but look how the pension fund started. Pension funds started really quite small. Of course, it's a different system. It's a mandatory contribution system linked to full-time employment. However, they have grown to be in excess of 10 trillion naira. And then when people start talking about, the way forward and funding infrastructure in the whole country, they then start talking about pension funds because there's such a large amount of money held there, huge store of value. So this is how the pension funds have done, and I think the managed fund sector will replicate that over a 5 to 10 year period. However, things are never quite so easy. So one thing we've seen is a lot of money coming out of banks, bank deposits, a lot of liquidity in the market, and a lot of money heading into the T-bill market, where rates are extremely low, and also into the federal government of Nigeria bond market, and the rates have crashed. And the yield curve, which is in the graph on the left-hand side there, has really come down a great deal. Now, this is really interesting because if you can imagine a situation where rates stay low for a long time, then you're looking at a structural adjustment in the way that people save their money, and more money will go into funds, and it'll be there for a long term, and it'll be extremely interesting. However, you have to remember that a T-bill rate at less than 3%, in fact, I think the stock rate yesterday was 3.05% in the T-bill auction yesterday. A T-bill rate at 3.05% does not compare very well with 12.82% inflation. So you might see something else happen. You might see rates go back up. Now, if that happens, then they're mark-to-market losses on bonds, and that would be very interesting indeed, because people are taking risk. Now, they're not taking risk in the sense that the FGN won't pay them back. They're just taking mark-to-market risk in the bonds that they hold. Now, let's not forget, it becomes a bit more complicated because most pension funds and banks have holdings of bonds that aren't marked to market, but nevertheless, there's a mark-to-market risk now. Now, if you compare this with my first slide, which was said that basically all you had to do for 10 years was put your money into the T-bill market and sit back and relax, because that was going to get you 2.5% more than inflation, you now understand that we've moved into a different age. Interest rate risk management, and actually all forms of risk management, are very important now, like they were not for a long time. So this is going to be an interesting period for all of us as we have more money coming into our markets, but necessarily, I think more risk has to be managed. So what is the outcome of this? I think the outcome of this is really it's something that's been coming out through the conversation we've been having throughout the day. It's about guidance, and also it's about diversification. So I think that, you know, at the end of the day, investors who are going to succeed need to understand quite a lot of asset classes, and not just T-bills, bonds, and equities. And there's a lot out there, and almost sort of weekly you find a new fund or a new product being launched, whether that's a money market fund, fixed income, credit solutions, dollar bonds, equities, and increasingly private equity and venture capital. So again, there are more options, both for the retail, but also for the professional investor to invest in. Now, I have a background in equities, and so I'm going to end up with, I'm going to finish off this presentation with an equity market chart. And I know that equities have been, you know, a pretty sour performer over the years, and despite the fact, and I would also distinguish that yes, we've had a great rally in the equity markets in April, but that's more of a trading gain. That's more sort of trading volatility than actually assessing the long-term risk in that market. So I wouldn't put too much emphasis upon that. But the equity market has not done well over the long term. It has not been a store of value. But it also comes back to what an earlier contributor to this conference said. He said that he had avoided the consumer-facing industrials and the consumers because he didn't think that, well, he think they were overpriced, and he didn't see the growth coming through. And a lot of the long-term underperformance of the equity market has been those consumer-facing industrial stocks. There's food producers, there's brewers, there's fast-moving goods producers underperforming the market because actually they cease to grow. If you take that away, some of the equity returns actually look a bit better. And there are, as we say, pockets of value. And one sort of litmus test, or one sort of benchmark that we use at Coronation Asset Management is try and look for companies with a long-term sustainable return of equity above about 20.5% or so, and start there. And it is, you know, slightly alarming that you don't find many stocks that do that, but there are around 8 or so that achieve that over the long term. And so if you're diversifying, there are some equities that you can include in your asset allocation and your portfolio. So that's what I've really got. I think what we're moving into is a very interesting period. We've got a lot of money coming into the capital markets from the increasingly young people who use tech to get into their funds. You have a very demanding, well-informed audience and customer base who are very good with communicating with each other and who will learn fast. And I think we're going to go out into a period now of investing in a range of assets that are going to be interesting, and we're looking forward to the next year and the years beyond that. Thank you very much for this chance.
Thank you, Mr. Guy, for your very interesting presentation. Indeed, my takeaway is that there are opportunities for everyone, both retail and institutional investors, and there's a need to understand the various asset classes. Thank you very much. We will be moving on in this program to the next presentation from Mr. Niyi Adenubi. Niyi Adenubi is the Executive Director, Institutional Business and Investor Relations at VFD Group. Over to you, Mr. Adenubi. Thank you.
Thank you, Rolly. And Good afternoon, everyone. And let me start by saying a big thank you to Business Day and to the Nigerian Stock Exchange for this invitation. I was given a very interesting topic, which is called New Perspective on Asset Allocation and Behavioral Finance in Volatile Markets. Rolly, I think you have the presentation. Are you presenting it?
Please go ahead.
Okay, so it's quite a long-winded topic, and it's quite maybe a complex topic for retail investors to understand. But my hero and my mentor is Warren Buffett, and one of the things that I admire most about him is in taking complex subjects and simplifying them. So basically, the concept is about what role does one's emotions play with how successful one can be in the market. And Warren Buffett had described this to say that if you have an average IQ, but with a good emotional discipline, over the long term, you can grow your capital and become very wealthy in using the markets. And I think that's very, very important. So basically, my slides just talk about how to stay disciplined, what biases to watch out for emotionally, and how to balance your portfolio so that over the long term you can make money from investing. Another concept that is also important in behavioral finance and economics is a concept called the prospect theory by Daniel Kahneman, who won the Nobel Prize for Economics based on this theory, which also alludes to the same thing. When investors suffer losses or pain, it registers in their minds more than when they enjoy gains. So the simple concept in finance saying, or investment saying buy low and sell high becomes quite a very difficult thing to implement. Because of emotional biases, we tend to actually sell on the low and buy on the high, and thus create a frenzy which becomes an euphoria or a bubble. So to be able to make the move to buy the low markets and ride the wave and keep eternally, or sell at the high, it's a very simple concept, but it's incredibly difficult to implement. So I hope that after this brief 10-minute session, you'll be better placed to know how to manage your emotions when investing, or better still, just appointing the right managers. So thank you, Rolly. You can move to the next page. Yeah, so on the earlier page, the previous page, was a quote from Jim Chinos, who is a short seller who was responsible for bringing down Enron. And he said, I've learned there's a big difference between a long focused value investor and a good short seller. The difference is psychological. And I think it falls into the realm of behavioral finance, which is also to say the discipline to stay with your conviction, even when you seem wrong in the market, also has to do with one's emotions. So there are a couple of topics within the behavioral finance subject that I'll just mention on. They're a bit boring, but we can check them out later, so I won't want to spend too much time on them. But there's something we call the confirmation bias, which is validating the information that you already have about a particular stock or particular company or by a particular sector. So your brain or your mind will work in such a way that you process all the information that you have as if they were like the ultimate truth. And this would lead you to make sometimes wrong judgment. There's also a concept called anchoring. There's a recency bias. There's a familiarity bias, which is also a big one to talk about. Sometimes when you know a name of a company so well and it's so familiar with you, and you're, for example, trading, let's say a Netflix or Google or some of those names that you know every day, you can tend to make the mistake to use familiarity bias to invest in those companies. And like I mentioned earlier about Daniel Kahneman's prospect theory, there's a loss aversion. when you lose money or when you buy a stock and it goes down and you see that red, typically when you're choosing a company or an investment or a stock, you like it for a certain reason. So if you like it at the price, say 10 Naira, if it goes down to 9 Naira, logically, it means that there's better value for you in that stock and you should be able to buy at the 9 Naira. Psychologically though, once we start seeing that we've lost 10% on that 10 Naira, what typically triggers in our brain is to sell that stock because we don't like to see those losses. Meanwhile, the logic is telling us that if the fundamental analysis that we did to buy the stock at 10 Naira still exists, then at 9 Naira, it's even a better deal. Another major bias is overconfidence. When you've been successful, maybe over a period of time, or picking one or two stocks, you tend to believe or start believing your own hype, and it's very easy to make decisions without checking one's blind spots extremely well. So that can also happen. Next slide, please. Right, so this graph just speaks basically about what I've just spoken about just now, which is a period between 2006 and 2010 and how investors behave. I've already spoken about this, so we can move to the next one. Okay, so our approach at VFD Group through reasoning, through biases, right? So first and foremost is that we have a very robust investment committee at VFD Group. We have also independent members be a part of that committee. So even when one person is suffering from any of the things that I mentioned earlier, a bias, an aversion for loss, once you come into the room and you have a discussion, the outcome tends to be more rational and more likely to be right. The second thing is diversification. This requires some expertise. Too much diversification would ultimately lower your return in the market. And if you're over-concentrated, of course, the risk is very high and you could lose your capital permanently. I personally am not big on huge diversification, but if you handpick, I said 5 in my introduction earlier in the earlier message. My colleague or my friend who spoke from Coronation spoke about 8 stocks. I typically have about 5 that I'm interested in. In Nigeria, 2 or 3 of them are banks, then 2 telcos, and then sometimes you balance it out with 1 FMCG. And I'll just really focus on those things as opposed to looking at 20 stocks. And then we have a very defined investment policy that we follow. So it's quite restrictive, but it also introduces some discipline, which is very much needed when you're investing. Next slide, please. So I'll talk a little bit about portfolio rebalancing, especially in a volatile market, and especially also in a changing market. For example, I think over the last 3 years, anyone who's investing in the market would strategically need to start rebalancing the weighting of different sectors and different stocks in their portfolios. An example is telcos and technology companies. The trends that we're seeing now in the world is that this kind of companies will dominate business. It's the 4th industrial revolution, and we expect them to be quite dominant in whatever sector they're playing in. Nigeria doesn't have, or the stock market doesn't have the fully tech companies, but in Nigeria, I would say the telco companies straddle the traditional businesses, but also incorporating some kind of technology into their business model. So I'd say that they as an asset, they as a sector pick will start getting a larger portion of my portfolio vis-a-vis some of the stocks that one would have liked in the past, which are the industrial stocks. There's also a differentiation that's happening within the banks. The top tier banks are getting bigger and their returns are getting larger. The IRR and return on equity is outperforming their peers in the middle and the lower end of their market. So as opposed to maybe 5-6 years ago, where you would want to buy all the bank stocks, today I'll pick only about 3 of them and manage my diversification that way. Next slide, please. When the CEO for the Nigerian Stock Exchange, Mr. Anyema, spoke earlier, he spoke about the ETF, the gold ETF, as an asset class that has enjoyed some good inflow in this period. I do agree that the market needs more depth and more asset classes on that platform. It's great that we have a gold index or ETF to track, but it also be good to have other commodities, either agricultural or hard commodities as well. So the gold ETF is very much welcome, but I think that the market needs other asset classes that can be invested in. Next, please. Yeah, so speaking of commodity investment, this is just a graph that shows the performance of gold and copper and cotton in the last year. Also, because of the currency crisis all around the world that's happening because each central government is printing money and quantitative easing so as to provide some kind of uplift or stimulant to their various economies. All investors and retail people across the world are no longer having a lot of confidence in currencies. For that reason, they're looking to hedge currency risks by investing in gold, silver, copper, and some are actually also using cryptocurrency, which has become very popular with a lot of investors. So I think that will be one of the major takeouts from this COVID volatility that we've seen. We've seen the US Federal Reserve pump more than 6 trillion into the economy. That would have an effect on the currency. And it's a no-brainer as to why we're seeing huge rises in the prices of gold and silver and the cryptocurrency. So next page, please. The challenges. So there are a lot of challenges in today's world. I think for the retail investors, picking the right asset manager or investment manager is your biggest challenge. I think you need to track very much the track record of those asset managers and do your research even on the personalities or the people that make up the investment committee or that are in charge of particular managers. I think it's very, very important that that's achieved. The second challenge, like I mentioned earlier also, is reallocating assets in a very difficult market. I think if you're an investor in this market, you need to start rebalancing your portfolio to reflect what I'll call the companies of the future, which are companies that have adopted technology as their core strategy to enhance whatever business offering that they have for you. I think now is also a great time to consider building a more robust portfolio based on long-term valuations. I think we're seeing some recovery in the market. We expect the foreign portfolio investors to come in at a later stage when there's a bit of clarity on the FX policies, and then the market will rally some more. So I would say that it's a good time to go in, but you have to pick your stocks very carefully. So I'll close by just talking about our companies and our philosophy as a company at VFD Group. VFD Group is a proprietary investment company, and we have about 13 operating companies within the group. Out of the 13, we have about 4 or 5 that operate in the capital markets, asset management, stockbroking firm, issuing house, and we also have like an insurance brokerage firm. And what we're trying to do basically is to build a digital ecosystem where all our clients can come and have a one-stop shop, get the advice, get your investment managed for you, but also trade on the platform. And we also have a digital bank, which is VBank, which is the base on which everything sits. we're also big on activist investing and also acquisition of companies. We've made some plays in the capital markets, doing strategic acquisitions over the last 3 or 4 years. We acquired a significant stake in an insurance company, which we've since sold. And we'll continue to look for such opportunities that put us maybe in the proprietary investment, private equity model. We have a very clear and defined strategy, and we are looking to also list on the NSE in 2022. In preparation for our listing, we've set up an investor relations function that's quite active. We're one of the first people or companies to have a virtual AGM at the onset of COVID-19 pandemic, I think in May. We have frequent calls for our investor calls quarterly, and we have a very accessible investor relations desk as well. So thank you very much. That's my presentation. We can go on to the panel now. Thank you.
Thank you very much, Mr. Adenubi, for that engaging presentation. We will now be moving on to the second panel session for the day. The panel session is themed, Is it all in the mind? Interpretations and perceptions of market events against performance. I would like to, at this point, introduce Mrs. Tosin Ajose, who will be moderating this panel. Tosin Ajose is the lead advisor of Deal HQ Partners. Over to you, Tosin.
Good afternoon, everyone. I'm just going to wait a moment for my video to come up on the screen, and then I'll start the conversations. Okay, yeah, good afternoon, everyone. My name is Tosin Ajose, as I was earlier introduced. This is the last session of the day, and we are almost completely out of time, but we will do our best to ensure that, we engage in very interesting conversations in the about 45 to 50 minutes that we've been given. Without wasting more time, I'll just go ahead and introduce the panelists who are going to be joining me in this conversation this afternoon. I have on this panel Lillian Olubi. Lillian is the CEO of EFG Hermes Nigeria Limited. We also have with us Niyi Adenubi. Niyi has just rounded up a quick presentation. He's the Executive Director, Investor Business and Investor Relations, VFD Group. And finally, but definitely not the least, we have Bumi Ashaolu. Bumi is the Head Equities, FBN Quest Senior, FBN Quest Nigeria. Apologies. Right. So what we are going to be discussing today is actually attempting to dimension investor psychology and investor behavior, understanding the things that typically underlie decision making when attempting to make investments in the capital market. So without further ado, I will just go on ahead and start with the questions. Let me remind the participants that we will take about 5 minutes, to answer questions from the participants. So if you do have a question from this panel, please send through on the chat function on whatever platform that you're working from. We'll do our best to accommodate as many questions as we possibly can before we have to wrap up the session. So I'd like to start by focusing on market performance and the psychology of investors. A lot of people have alluded to the fact that investor psychology is not necessarily always consistent with facts, data, or underlying market fundamentals. And permit me to quote the words of Sir John Templeton, who's the founder of the US-based asset management firm, Templeton Investment, who says that bull markets are typically born in the time of pessimism. It grows on skepticism and matures with optimism and finally dies on euphoria. These are some of the different levels of sentiments that happens in the market. And I know that many of us have seen the Nigerian capital market go through several of these different stages of emotion and turn different cycles even at these different stages. So my first question, which I would allow each one of the panelists to respond to, will be, right now we see that the market is about to make a turn, and we are seeing a lot of interesting turn at this time. So I'd like to know whether we feel that as the market is approaching a new turn of a fresh cycle, are we expecting that having been, having had, a lot of downtime in the market, are we expecting, investors to enter into, a wave of reckless optimism at the first, sign of recovery? Or do we think that they are going to go through, the whole cycles of pessimism and maybe subsequently skepticism before the market eventually makes a full turn? I'll start with Lillian and then possibly go to Nii and then Bumi. Lillian, over to you. I think you need to unmute your microphone.
Yes. Thank you very much. Thank you. Thank you, Tosin, and thank you, Nii, for that insightful presentation, which I think lays a very good foundation for this session.
Thank you, Lillian.
Approaching a fresh cycle. Tosin, my easy answer will be, I don't think so. And this is why I say so, because it is true that markets are, cyclical in nature, and often we see these cycles that return, following very long periods of suppressed valuations, which is the situation we have now on the. But irrespective of the psychological responses which you mentioned and are true, they're often, triggers, I think, that sort of must follow these things. And if you remember from the session before ours, where the MD of CSCS mentioned the things that have happened in the economy before these cycles were precipitated, you will find that we're not there. And so firstly, I think the first challenge for me is that we are in very unprecedented times. And I think in many ways, many things are still unfolding in terms of the lagging effects on the real sector, on businesses, on households, and even the listed companies. And so we haven't seen the full scale and extent of what we're dealing with. Secondly, and maybe more importantly, is that the marginal investors in the market are the foreign investors, irrespective of the trade splits that the NSE produces, which is local versus foreign, putting locals at 60%. I think based on the way that the foreigners trade, they're the influencers of price. And it's an open secret that this segment, who have exited most other frontier and emerging markets, have been forced to remain in this market, due to the currency and repatriation challenges that we've been having, and have chosen to reinvest their funds, instead of leaving them dormant on the queue, waiting for the foreign exchange. And for this group, confidence, liquidity are very key issues. Liquid currency, markets are very key factors to their comfort. So I think it begs the question that when they leave, what happens? Now, fine, we shouldn't have total reliance on this group. But when you look at what we have now as the local market emerges, you ask yourself, when you look at the local institutional space with the foreign, with the institutional and retail clients, you ask yourself whether it's enough to move the market. So you have PFAs who have less than 5% of their portfolios in equities. You have the retail segment who are mostly followers, for want of a better word. You sort of go through the head mentality issue and are not self-analytical in and of themselves. So I think this will pose a challenge for now, and it will take a very compelling macroeconomic story for us to see an alteration in the dynamics or see, let's say, a new cycle emerge. You also remember on the last boom that we had, there was a confluence of liquidity, of issuances, of many other things, and macro environments that supported that. Right now, the environment, macroeconomic environment, do not support this. So there's a lot of ongoing initiatives and policies we're hoping to see that will drive change, but I don't think they will be immediate. So my take is that it's going to be beyond just the first sign of recovery. I think, we would have to see very strong and sustained signs of recovery before we can talk about a reckless optimism, as you put it, Tosin. So that's my view. I don't see that cycle emerging right about now.
Okay, thank you. Nee, I'd like to hear your take, but I'd also like to know, from your own perspective, because it looks like there's still, somewhat of a lot of activities happening in the private equity space. I mean, at this time, even though, the economy is stifling and a lot of, things, that we are not seeing, that many activities in the capital market. So what do you think we would see in the mid to long term, in the market, just, in line with the earlier question? Do you think that, private equity would have an upper hand with investors at this time, or do you?
Okay, that's an interesting dimensioning to the. That's a very good, interesting dimensioning. People pattern that happening necessarily quite soon. Also because we don't know how the economy globally shapes out with a post-COVID world. Also, the last two recessions that we've had in Nigeria, especially the major bust after the 2008, 2009 bust, has most people. However, I do have some hope that younger people, 2008 and 9, and through new technologies that are available, will be the savior of this market. So I expect more day trading, more sophistication in terms of algorithm, maybe over the next few years. But I think that we're still maybe a while away. The other question about private capital making a significant play in investing in equities. I think that's been the trend globally. I saw a report last week that showed that the number of companies that have gone to the market to raise capital compared to the 90s has gone down by about 60%. So typically in the 90s, once you have an idea, after about 3-4 years, you go to the capital markets, you do a listing, an IPO, and you raise money. Now, most companies prefer to also go private, which is quite unfortunate because only institutional guys can participate in the private market, which is private equity. And that also adds to wealth being created for only a segment of people and not being shared across board. So I hope in Nigeria, we're able to introduce policies and encourage companies to list. I've been championing like the listing of MTN and Airtel and the other telco companies for some time. So I'm glad that happened. But the Nigerian Stock Exchange plus the SEC and the government need to be deliberate about encouraging companies to list on the stock exchange and make it also easy to list and easy to stay on there, because there's a lot of private equity money that's available. And sometimes it's just always easier to have one principal than to be a public company regulated by many.
Thank you. Thank you, Nee. Bumi, I'm sure you'd like to say one or two things to add to that, what has already been said about the question.
Thanks, Tosin. Good afternoon. And also to say thank you to Business Day and the NSC for organizing this. Yeah, much has been said about this question. I'd add my 2 pence worth. I think, first of all, it's hard to say or to predict that a fresh cycle or recovery rally is on its way. Not because I'm saying that there isn't one. I'm just saying it's very hard to predict one. For Nigeria specifically, for any of this to happen, it has to be macro-led, and I use the word macro very loosely. I just mean anything that is beyond the market, essentially. So whether it's all recovery or some sort of stability on FX or some mega reform that people are really excited about, it is easy to point out the reasons why investors, whether they're local or offshore, wouldn't participate in the market. But you'd be surprised that if one thing goes well and people are quite impressed by it, it could easily change the sentiment that people have about a market. So if you remember when the NAFEX window first came up, there was a lot of uncertainty and questions as to whether it would actually work properly. And at some point, everybody realized that actually it solved a problem. Maybe it wasn't perfect, but it solved the problem. And that helped a little bit. And eventually that snowballed into people having a bit more confidence in the markets, which helped both equities and the bond market at that time. So if indeed we get a catalyst, I don't know what that would look like. I would say that it is very possible to get a rally kickstarted, just because of the way investor psychology sentiment can go. I mean, you only have to look at the US market to see how this can play out. So in Nigeria specifically, valuations are very depressed, and that will give some people a reason to say, actually, something that I was complaining about has been taken out by this catalyst. Therefore, I'm happy to get involved. Because the valuations are so depressed, any decent gains you get will spur on other people. And at some point, you may get both the so-called sophisticated investors as well as the non-sophisticated investors doing exactly the same thing, which may ultimately lead to some reckless optimism, as you put it, as that phrase. But I think, first of all, the major issues have to be resolved first, even if it's just one modest improvement in whether it's liquidity, whether it's FX reform, whether it's some other reform that people are excited about. And to finish, I think this word cycle, I think one has to be very careful about this, because if you get a monster rally, investors will be very happy, even if it's not a proper cycle. So I think we're just waiting on something that is going to be positive, whether GDP growth or FX, that will give people a bit more lift to lift their heads up.
All right. While we are still hoping on that positive trigger that would take us, to a point where we can agree that the market is actually in recovery. A lot was said, in the course of the conference about the psychology of foreign investors, specifically from Eric's presentation. He alluded to, a number of things around how foreign investors typically look at our markets. And one of the things I took away from his presentation was that we should look to build the Nigerian capital market via local investors in the first instance. So I'm going to be asking, this question is specifically directed to Lillian. So in trying to dimension the psychology of local investors, would you say that there is sufficient data to guide investment choices across, the investor demography? And how mature would you say our local investor demography is at this time? And what do you hope to see the stakeholders in the market, like the brokers and the Nigerian Stock Exchange, and even issuers of securities? What would you like to see them do in terms of, investor information and engagement? What are your thoughts?
Thank you, Tosin. A few questions there. So on whether there is sufficient data, broadly speaking, there's quite a lot of data between the websites of the exchanges, between these newswire companies. There's quite a lot been, and of course the regulation that enforces information. I think the question is, do we have enough savvy retail investors to access or comprehend the information that is being put there? Or is the information disseminated in the form that is needed by them? And it's another question which, hopefully we'll get to. Secondly, you ask how mature the demographic is. First of all, it's the demographic of the retail investors is quite small. And we heard again from the previous panel, the number of active clients this year in the retail space. But within that segment, there are actually different segments and different types of retail investors. And even though I work with a company now that's predominantly institutional based, I've had most of my career dealing with retail, the retail segment. And so I have, a fair sense of how that plays. And so you have a lot of those people who are, a few of them who are very active, quite sophisticated. These are your mid-level senior executives who are playing the market very intelligently, generating some, alpha to their personal and group portfolios, because these days a lot of them are investing in baskets. And you see some of that effect in some of the companies that are very focused on online platform retail. Then you have another subset of investors who are very docile, very inactive, and they're the ones that usually just sort of follow and they jump in the bandwagon when there's change and where they see somewhat of a change in the market and things like that. And then, of course, you have somewhat of a growing retail millennial that has access to data. They have a form of savviness, I like to say. But when you look a little deeper, you find that they also do not know much about the markets, and there's a way also that they interpret and how they are influenced by their decisions. And those are the issues. Of course, with the inactive, we saw what happened with the 2007-6 bubble, and the way that the retail investors jumped in with very minimal information. And you see why the effort now with the regulators is to try and concentrate them toward managed funds, and have them be in these baskets where they do not have the responsibility or burden of making the choices themselves. So lastly, on the efforts, or rather before lastly, on the efforts with the brokers, the regulators, issuers, the regulators have done, or are doing, I should say, phenomenal work. We're trying to improve financial literacy drive across, different segments of that pot. And we see, of course, with the NSE disseminating information in very simplistic ways. And if you look at the NSE website, you see they created this magazine just to break things down for these investors. We see the SEC, who has a financial literacy committee on the capital markets committee, doing a lot of work with schools. I hear there's now financial literacy curriculum added to the curriculum in some secondary schools. And it's undoubted the amount of push. The question again for me is, are we measuring the impact, and are we addressing the approach of this financial literacy drive? And you mentioned an important group about the issuers, and I don't think that segment is doing enough to sustain that drive. And so what we find now with the issuers is that most of them concentrate on the institutional client base, and you see them often do some road shows. You see them have these client calls and meetings to address and facts behind the figures. But you're not seeing them, I'm not seeing them focus a lot of effort on the retail segment, and I think it's an interesting thought that we might actually be missing out of. And so we need to direct some effort there. And I think it brings a very useful opportunity in the information drive for corporates to begin to consider selling their stories in a simplified way, to garner that subset. There are lots of companies now, and I'm not sure I have the permission to list them, that are doing phenomenally well, that need to tell their stories, not just to the corporates who are already in, but to these other segments that we're not looking at together, especially the millennials who are ready to look for, or are more open, I should say, to some risks. And so apart from that, of course, I think also collaboration between all these agencies, i.e. these fancy companies, news companies that are putting out good information, these issuers and the regulators, and alongside with the brokers. I think that collaboration would do a lot more to make sure that the targets and the import of what we're trying to do with this drive is achieved.
Thank you, Lillian. I think it's very interesting, that you note the fact that a lot of times the retail, segment of the market is not much attention is being paid to that segment of the market. And I want to also mention that even some of the information that goes around, even after making the investment to shareholders and unit holders in some of these funds, I think that simplifying, for instance, your annual reports and those documents that you typically circulate to investors could actually be very helpful. A lot of the institutionals have people whose job it is to actually dimension, understand, and advise on the impacts, or the facts behind the numbers. But many of the retail investors can't really do that. They measure performance simply by returns, which is, not necessarily always perhaps the right way, to look at.
And to mention, Tosin, that is the way, that is the new tomorrow. That is the area we need to concentrate on. We're literally the most stable and sustainable group subset that, should be major players in the market. So we don't have a choice. We need to focus on that group and make sure it works sooner the better.
I'd just like to add just a couple of points here. So Lillian, I think that's a fantastic point that you made. And I think I also was alluding to that earlier when I mentioned that the future of the market depends on the younger people today, which is mostly retail and also technology. For us at BFT Group, we actually grew on the back of retail investors. So our initial attempt to go straight to institutional didn't work out. And so we reverted to small investors. And it was small money, 100,000 naira, 200,000, 1 million for a long time in a private company. And we found and we learned through that process that even people that are not savvy or interested in business or finance. They want to save money and they want to invest money. So if you can devise a process to carry them along well, they will support you through your whole journey. And now we're a public company, PLC, and obviously for that reason, also moving a bit institutional, but it's also very core to our strategy that we never lose that retail connection, because we also do believe that it's the future of investments.
Thank you, Nii. So let's go and talk about hype in the market. I mean, apart from fundamentals, there are other things, other nuances that shape investor behavior. So I mean, some people believe that it's more sentiments than fundamentals. Some other people believe perhaps it's more fundamentals than sentiments. But let's understand when we talk about sentiments. So people talk about hype in the market. So if we say that investor behavior is sometimes driven by sentiments, Nii, would you want to tell us how you think that sometimes these sentiments are formed? Is it actively propagated by the media, or by analysts, or digital marketing platforms? And do you think that issuers actively develop a hype strategy to sometimes influence the performance or pricing of their securities on the capital market?
This is a very tricky question, and I will try not to get in trouble.
Please don't get in trouble, but please tell us what you honestly think.
I think like everything else in life, I think there are good actors and there are bad actors. I think that companies need to tell their stories so that the investing public can understand it and make decisions as to whether they want to be in those companies or not. Drawing the line between calling it a hype or a false sentiment is very difficult for me to say. But I think that historically, if you've studied the markets, we've seen all kinds of actors. We've seen people deliberately hype a particular stock and it rises to a crazy euphoria. I think in the global markets today, there's a stock this year that has risen, I think, about 300%. And it's fair to say that the chief promoters of the company are also encouraging the behavior. So they can see the hype there. You can see, I think the SEC has tried to sanction the company about 2 or 3 times. So there's a deliberate effort to do that. However, I still also think that the media, the promoters of the company, that collaboration, it's all very necessary to give enough information and create some kind of buzz for people to be excited about a company or a sector or by a particular market. But where you draw the line as to where you cross over can be quite difficult to say.
Okay, Bumi, I just want to know what you think. I don't want Nii to be the only one getting in trouble, just in case he does.
Yes, share this with me, Bumi, please.
I mean, what do you think about this hype? Who's responsible? How does it impact the market? And do you think issuers deliberately develop a strategy to hype their securities in the market?
Well, first of all, I'll say that this is not, if this exists, which it probably does, it's not a Nigerian issue, right? It's not a Nigerian only issue. That's why you have regulators, whether it's in Nigeria or elsewhere. I think if you are not careful, whether you're an issuer or a newspaper or an exchange or whatever, there's a propensity to slide down this risky slope of wanting to promote something because you want things to be better. So if you own assets or you own a stock, or if you're an investor relations person or you're CFO of a company, obviously if your stock does better, then you will probably find that your package, your compensation will be linked. So there's a risk that if stakeholders don't watch themselves very carefully, that you find that you would end up doing things that you would, in theory, not expect yourself to be doing. So I wouldn't say that one person is responsible for propagating practices that are not befitting of what you expect in the capital market. It's just something that's part of human nature, and everybody just needs to be aware of it and really put policies in place that would prevent the worst side of us human beings for coming out. So I don't think it's one particular group responsible for any of these.
Yeah, Tosin,
Okay.
I would like to just add also that besides like trying to control it from a regulatory perspective, which can work and is usually effective, I'm a big believer in markets. So markets function, they always function. And in this case is to grow in like a case like Nigeria, where we haven't grown a shorting market. If you promote a company illogically just because you're hyping in just to get a fair price, if there's a considerable shorting market in that system, you would be, it would happen that professional people who are shorting the market will pick up the noise very quickly and will start to make the moves to counter that hype. And through that back and forth, that would reduce the number of bad behaviors that you can find in the market. So the regulators can try to do as they're doing, it's effective, but ultimately we should look for a way to find a market solution, and having a good shorting or ability to short a stock would be fantastic.
Okay, I mean, just before we leave that point, I just wanted to, make a reference to the fact that there is a lot of, promotional activity that actually goes on the on social media and what have you, and a lot of, companies that play in the capital market do a lot of things around, that space. There are a lot of, subtle ways that, people promote, the activities of their organizations and sometimes even their securities. I mean, I just wonder whether the regulators actually catch on some of this information that is subtly disseminated across, some of these platforms. It's not a question. It's just an interesting thing that I wonder whether, whether anyone is checking or looking at. I'd like us to quickly touch on the role of technology in bridging the gap. I know that, when the Nigerian Stock Exchange CEO was speaking earlier, he alluded to some of the major milestones that the Nigerian Stock Exchange was able to accomplish, during the period of the lockdown and even subsequently during this period of pandemic. And he alluded to the fact that they were able to transition fully to their virtual trading platform. And I also know that they were able to do this quite seamlessly. So, I mean, this could suggest that technology might very well be a defining factor for developing, the Nigerian capital market. And so I'd like to ask Bumi, how do you think that we can use technology to drive efficient investor education and engagement?
Thanks, Susan. So I think the first thing I'll say is investor education in general, should be part of life for every investor. It shouldn't be an add-on. It should just be, like BAU. It should just be normal. But up until I think this crisis hit, you would find a million reasons why people would give reasons, whether they're invalid or valid, or excuses for not adopting technology as much as they should have. And I think this goes across, I don't want to say everyone, but most people, investor groups, organizations, whether it's even private, public sector, we've all been a bit slow to some extent. With the pandemic, I mean, even this conference that we're having, suddenly it's supposed to be perfectly okay. So I think it's when you see some of these really extreme scenarios happen that we suddenly realize actually some things should have been tested properly before, and it's okay. So I think the first thing I would say is opportunities for engagement like we're having today between investors, market participants should be made available and to be broadly accessible. And all parties need to come together, NSC, media, sell side, buy side, all the communities should be working together to promote engagement forums like this. And the second is maybe a charge to the private sector to do better with the enabling of online access for the retail investors in particular, and not just for trading, but actually to engage. Because it's one thing to learn, to use technology very well, but you don't want to be stuck in manual or analog when it comes to the actual trading execution experience. So I mean, this should apply from your onboarding all the way to your trading. I mean, CEO of NSE was referring earlier to remote trading and how the exchange has facilitated a very smooth working environment. We've all had to, right? I'll just encourage, I think, all parties to continue to push to be able to get the investors much closer to this market, because up until now, we will always find reasons why maybe it's a capital injection, investments that we need to make that are significant. But when the pandemic hit, nobody was saying, oh, actually, it's going to cost too much. For this market to really move in leaps and bounds, getting investors to be able to engage properly and then obviously, trade with technologies is a big, big, big requirement.
Lillian, I just, really still talking about this stakeholder engagement and looking at the market, as a larger framework. A lot of conversations have been had since the pandemic about, also ensuring that we are able to optimize, the experience with the government side of things. And so I'm going to ask, what you think about, being able to enhance, the capacity of the regulators at the moment to, touch on this. What kinds of technology innovations would you be expecting to see from, the stakeholders other than the market itself, like maybe the SEC or perhaps the central bank in terms of, derivatives trade and fixed income and the rest of it? What kinds of innovation do you think will support, this the drive of the markets, from their end?
Okay. Thank you, Tosin. So, as I said, technology is everything. And if we didn't know that, I think this pandemic has shown us very clearly how the world moves with technology. And I think that the data speaks for themselves. So if you're talking about, they say almost, I think, 85 million mobile internet users in Nigeria, 27 of these active on social media. When you ask the question, what can the regulators do? I think it is obvious that we need to be in that space, to be where the people are through technology. So it's a big pool of potential investors when you look at those numbers of people who are on their phones, and you also look at the data of the number of times those subsets are using social media actively in the day. And so it is to divert some attention to our tabs, to our handheld devices, apart from the less traditional ways that we have hitherto sold. I think the NSE and the regulators have done, I don't see any gaps in terms of the technological infrastructure that's already in place with the stock exchange. They look ready to scale from a derivative standpoint, from a increase of asset class standpoint. They have state-of-the-art technology that's ready for that. And it was nice to see, as Bumi had already alluded, to see the transition that happened even when the lockdown started, with the seamless nature in which 200 and something brokers were able to transition very easily to trade remotely without any issue to date, which just sort of evidences what had been put in place and even for the future asset classes that they need. And so again, is to coordinate efforts, right? So it's to collaborate, perhaps the regulators and these stakeholders with these guys who are tech savvy, with the financial journalists who are using technology to pass on messages. There's several of them that we know of. And so let's not also forget, of course, that technology is an amplifier of volatility, which is created by greed and fear. So we see those, but it's a healthy way to go. We have no choice, and I think the markets are ready for that. But it obviously has the power to transmit market contagion very quickly, and it's how markets grow. And so there's no way around it. I think it's really about the regulators and these subsets meeting the people where they are through our devices. I think it's the first step.
Thank you. I'll quickly ask a question around data and data analytics, but I do hope that the organizers will give us some additional 5 to 10 minutes for this panel session, given that we actually started, slightly late. Please let me know whether we can stretch just a little bit so that I'm sure we can take all the questions that we have. So, Nii, I'd like us to talk a bit about data. And I know that, the market fundamentals are typically driven by, access to data. So my question will be, will the use of technology for data collection and analytics possibly eliminate human influence in investor decision making and just generally trying to, analyze the market? How much of data would you say is available? I mean, for the different demography, institutional investors, retail investors, and even HNIs. Are we at parallels with other markets, or do we have more work to do in terms of just ensuring that there's sufficient repository functions going on? I remember that I think Jallo had mentioned in his presentation that they do a lot of data collection at the CSCS and make this information available. I don't know whether that availability extends to retail investors, but what are your thoughts in terms of data availability, one, and the use of data analytics to actually take investment decisions?
Okay, thank you, Tosin. This is also a very, very, very interesting concept that we're dealing with in the world today. So we're just talking about technology, which is a game changer. But with the technology, the data is now everything. You asked if we're at par with the rest of the world. The simple answer is that no, we're not. I think some of these other sophisticated...
Kindly let's keep your answer to 2 minutes. I'm being prompted that we actually do need to wrap up. Let's keep the answer to 2 minutes so that we can take at least 1 or 2 questions.
All right, no problem.
Thank
you.
You.
Yeah, so there's no question that there's still a huge gap in terms of our data readiness and using data and algorithm ultimately to be able to predict markets and possibly eliminate, perhaps not, but reduce the human interference in the markets. In more sophisticated markets, I think they've gone extremely far. In our markets, not so much. The technology that's set up and data acquisition will continue to improve that. I'll give it 5 years. I think that we will also be quite sophisticated in the Nigerian capital market space, using data and technology to predict the markets. But if I'm to keep the answer short, yes, it's a game changer. It's a new world. We're seeing fat fingers type trades these days. We're seeing trades being analyzed and executed in seconds or nanoseconds. We can see trends being analyzed in nanoseconds. So the edge is for how powerful your tech and your systems are and how quickly they can accumulate and read the data and then make decisions. That's the trend in which we're going in the world. So definitely the data is a game changer also.
Thank you very much, Nii. I've been told that we can actually have about an additional 7 minutes. I'll try to optimize the use of these 7 minutes. So let's talk about the journey to recovery. I'll take just 2 questions and then we will move the conversation to the audience. So in the face of dwindling economic performance and most recently a lot of heightened business insolvency risk, shrinking foreign reserves, like a lot of people have mentioned in the course of the conversation, decline in productivity, falling consumption rates. The capital market generally has not been insulated from this general, economic performance in the market. And at this very uniquely challenging time, both the public and the private sector will be looking to the capital markets to meet their funding needs for operational funding, for recovery, and for growth. So my question, which is first of all directed to Bumi, is will the capital market be able to deliver sustainable long-term capital that will set the real sector on the path to recovery? I'm hoping your answer is yes. And if it is yes, how long before we start seeing, some of these positive, changes and actual delivery of capital needs to real sector?
Okay, I'll give you a nuanced answer. So in theory, yes. The question is, will it? I mean, honestly, it's too soon to tell because there's much riding on one thing, which is really confidence. If we get some sort of improvement, again, at this sort of micro level, whether it's through luck or design, trickles down, encouraging all parties to have more confidence in each other and the markets. And there is ample capital. It's just that it's either very difficult to part with by those that have it because they would rather give it to entities that they trust will give them a decent return on it, right? I mean, ECM, equity capital raising, hasn't been as vibrant as would like, especially when you compare it with the debt markets, which has broadened out beyond domestic to hard currency, even commercial paper. But it would be great even if those ones you see longer terms on them, in terms of how many years maturity, or if the number of companies that can access those markets are broadened out, because right now there's too much narrowing. So I think private sector pushing the boundaries to create more products. We see that, you see a lot of that happening, but what you tend to find is that the pushback or why these things don't get done, or why there's not enough buy-in, is because there's a lack of confidence, whether it's from the regulator, whether it's from the investors. So that word confidence, I think, is the thing that needs to work out. The largest pool in this country is the pension industry, right? For capital funds. If there is a bit more encouragement that can be brought in to incentivize diversification beyond risk-free assets, if you think long-term, there has to be some sort of balance between just keeping the money super safe and meeting the future obligations, because right now there's a big gap that's growing between the obligations that need to be funded and the returns that you're currently getting on these assets. So I think a bit of shift is required, just in the way all participants sort of get together when it comes to capital raising in markets in general to boost confidence. And I think if those things align, then the answer to the question will be a bigger sort of capital letters yes.
Okay, thank you very much, Bumi. I'd go quickly to Nii. I've seen a lot of comments coming in about the foreign exchange regime and FX crisis and all of that, and I just want us to touch on this in a minute or two. So one of the major sources of foreign exchange is FPI, foreign portfolio investment, coming into the country. Listening to Eric earlier, I think that we know that there isn't a lot happening in terms of inflow of foreign capital. So Nii, what do you think the market can do? So I know that we need to develop, local, our markets using local funds, but we have, significant reliance on foreign exchange, even from the real sector. And at this time, even if we wanted to fix that, it's not going to happen in a year or two. So what can we do to ensure that the capital market is also able to have a fair share of foreign exchange inflow that can possibly ease, the current tension that we have in terms of, the foreign exchange markets at this time? Please, 2 minutes if you may.
Okay. Thank you, Tosin. So I think that regardless of how good we might be with our economic structuring, I think that for all frontier and emerging markets, they need foreign direct investment and foreign portfolio investment. You just absolutely need it. You can't shut it off. And if you're arrogant to shut it off, then you're going to be in major trouble. So at the beginning of this program today, I was very surprised because when I was thinking about this question, I was thinking that I'll encourage the NSC to work closer with the central bank, the Apex Bank, to formulate policies that will make it easy for foreign investors to move their money and just have very good, effective FX policies. So I was very surprised when he himself asked for a more collaborative CBN. I was stunned, which means that it's unbelievable. So I was part of not getting into trouble today. I will just leave it at that. But it was quite surprising.
I was just going to remind you.
I'm still very conscious. So it was very surprising when he said that. But I'll just say that I do hope that all the regulators find a way to collaborate better so that they can formulate policies that benefit the entire economy at large. We had issues with some companies that listed through a GDR to be able to pay their dividends in dollars. It was not very encouraging. A lot of people sold their naira-denominated assets and they couldn't move their money. It's not very encouraging. So I think that what he asked for is also what I would say. We need to find a way to resolve and unify FX policies, and also encourage a diversification from crude, even if it's still natural resources. There's gold. There's very many other things that they're trying to encourage now that can bring in inflow of foreign currency. But it's just absolutely crucial. I think the most fundamental thing that we face over the next couple of years is how we manage our FX policy, to be honest. So.
Thank you very much. At this point, I'll just take one question from the audience. I have one more question to ask Lillian on equities. I do hope that we'll be able to take that, but let me just go to this question quickly. I don't have a name here, but the question says, considering year-on-year inflation compared with expected returns on investment in local stocks, is it really advisable to invest in securities on the stock exchange? This is from Iduku Lawson. Okay, there is a name. I think I'll direct the question to Lillian.
Thank you, Tosin. So it's very interesting that there's aversion to the market for the same reason of negative real return. But when you look at it in the long term, this is the market that you want to be in to beat inflation, and the numbers speak for themselves. And so it's a very interesting space that we're in. And you find local institutions who are out of equities because they need safety. They're dealing, and there's a distortion there because they ideally should be, taking care of pensioners with a long-term view, but they're challenged. You have the people who are also following that standpoint. But the reality is that, the stock market is the long-term market, and it's a market that beats inflation and meets that need. So you don't see the immediate effect like you see with the fixed income, your low rates and your high inflation rates, and obvious negative returns. With the capital markets, and the numbers speak for themselves, over the years has proven to be a more efficient market to be in to solve that problem. But unfortunately, I guess we all have near-term incentives that we need to take care of that make that a challenge. And I hope that can be fixed sometime.
Okay, thank you. We are now completely out of time, but it's been a very interesting panel session, even if I have to say that myself. I'd like to first of all thank all our attendees who have joined us and have stayed from the beginning till this time. Thank you very much. Thank you to Business Day and the Nigerian Stock Exchange for putting this together. And the biggest thank you goes to my panelists. Thank you so very much for making the time to be here. Thank you, Niyi. Thank you, Bumi. Thank you, Lillian. And I would at this point immediately hand back, the session to Rolly of Business Day. Thank you very much, everyone, for joining us, and have a very good afternoon.
Thank you, Tosin, and thank you, Business Day and NSA. It's been fun. Thank you.
Thank you, Tosin. Thank you to our esteemed speakers for sharing your wealth of knowledge on that interesting panel discussion. Mrs. Lillian Olubi, CEO, EFG Hermes, Mr. Niyi Adenubi, Executive Director at VFD Group, and Mr. Bumi Ashaolu, Head Equities at FBN Quest. Thank you so much. We will now, at this point, be going to take the results of the polls that were shared earlier. The polls are being displayed on your screen, and quickly, the questions that were asked. The first question was, Will the recent shock reforms of electric tariff, VAT increase, and petrol subsidy removal, will it be a net benefit for the Nigerians? 52% of respondents said yes, while 48% said no. For the second question, the growth sector window on the Nigerian Stock Exchange was conceived to target SMEs for listing. What factors have held back the SME IPOs? 38% said few stories of sustained successes of SMEs on the NSE. 28% went for cumbersome reporting requirements, while 17% each alluded to fear of loss of control and illiquidity of penny stocks. Thank you. And at this point, we will be taking a brief advert from our sponsors, and we will be coming back with the closing remarks of the MD, Dr. Ogo Okiti. Thank you. Welcome back, Dr. Okiti.
Rolly, thank you so very much. And thank you for moderating the transitions since 10 a.m. So my name is Okiti, and I am the Managing Director of Business Day Nigeria. And you have been watching the Business Day Investment and Capital Market Conference 2020. For me, personally, it's been very, very insightful, very engaging, and quite a lot to take in. So the presentations have been awesome, and the conversations have been quite revealing, I must say. So the 4 hours that we have had has just gone so very, very quickly. So I thank you all. First, let me thank all our speakers, because they have not only shared their time with us this morning and afternoon, but they have also shared their knowledge, their insight, and their wisdom on the capital market in Nigeria. So I thank all our speakers. That's including the leadership of the Security and Exchange Commission. That's Lamido Yuguda, the Director General. We thank you, sir. And the leadership of the Nigerian Stock Exchange also, that's Oscar Onyema. We thank you for your time and for your insight during this conference. So many other speakers, Eric Renada, Aruna Jalo Waziri, Omobolanle Adekoya, Unamdi Nwizu, Ete Hogo, Uche Obi, Kastoski, who is of Coronation Asset Management. We have Tosin Hajose, Linear Lubi, Bumi Asaolu, Niya Dumbi, and of course, the 2 powerful moderators for the sessions that we had, Omobolanle Adekoya and Niyi Adenubi. I thank you all so very much. We know, because of the work that we do, that executive time is very, very precious. So for you to have taken time out to be with us in this conference, we sincerely give you our profound thanks for doing that today, and for enriching our audience with your wealth of wisdom, knowledge, and insight of Nigeria's capital market. And speaking to our guests, I really do hope that just like me, the conference today has provided you with some solid outlook and expectations for the coming year. I really hope that that benefits you in the investment that you make, and of course, in the choices and financial choices that you make. And of course, we have also taken note of some of the challenges and the difficulties relating to investment in Nigeria. I mean, you can't talk about investment in Nigeria without talking about exchange rate, devaluation, inflation, interest rates, and choices and the decisions that you make. So let me also thank our sponsors. It's always very, very important to thank our sponsors. And the reason is very, very simple. Our sponsors, why we provide a platform, the ability for us to come to you this afternoon has been made possible because of our sponsors. So I'd like to thank all of them. We have the Nigerian Stock Exchange, the FBN Quest, VFD Group, Ancoria Asset Management, Alliance Law Firm, EFG Hermes, ST Health Trustees, Commercial Partners, and the last but not the least, CSCS. We thank you all for your contributions, and we thank you for the partnership, and we thank you for the sponsorship. We appreciate the contributions that you have made, and we really, really do hope that we can continue to build stronger partnership for a stronger capital market in Nigeria. Finally, I'll come back to you. You have been watching, and I hope you have benefited for the past 4 hours. So I really thank you for sharing your time with us here today. And we hope to see you in our future conferences and engagements with our readers and our subscribers. On that note, I would like to say, please enjoy the rest of your business day afternoon. God bless you. Bye-bye.
We help them manage their affairs through the instruments of will or living trust. This helps them to also sustain their assets in the lineage even after they have passed on. This we do in form of estate planning. We also act as trustees to CIS, funds, mutual funds. Under mutual funds, we act as trustees to protect the interests of the unit holders. All forms of mutual funds, money market funds, fixed income funds, real estate funds, balance funds, name it, we act as trustees to all these funds, protecting the interests of the unit holders. Our major role is to ensure that issuers and managers of funds keep to the terms of their transactions. This helps us to get people to invest in our economy. Confidence of the investors will grow in the market and more funds. Without the capital market, our economy is going nowhere. And what we expect from the NSC, especially in this period, is to automate everything so that the practitioners will be able to render their reports seamlessly. Estate Trustees has been around for about 3 decades. The company was incorporated in 1991 and was licensed by the Securities and Exchange Commission to carry out the business of trusteeship and funds management. We act as trustees to the public trust, corporate trust, and private trust. Under public trust, we act as trustees to state bond issuances. As a date, we act as trustees to over 25 state bonds across the 6 geopolitical zones of the country. We also act as trustees to federal government-backed debt issuances, such as FGN Sukuk 1, 2, and 3. We have the Nigeria Mortgage Finance Company. We have local contractors receivable bonds, and a couple of FGN-backed debt issuances. In the area of corporate trust, we act as trustees to some corporate bonds and notes to ensure that the interests of the investors are well protected. In the area of private trust, we act as trustees to private individuals. We help them manage their affairs through the instruments of will or living trust. This helps them to also sustain their assets in the lineage even after they have passed on. This we do in form of estate planning. We also act as trustees to CIS, funds, mutual funds. Under mutual funds, we act as trustees to protect the interests of the unit holders. All forms of mutual funds, money market funds, fixed income funds, real estate funds, balance funds, name it, we act as trustees to all these funds, protecting the interests of the unit holders. Our major role